Hold on. I'm back. Morning, guys. This is going to be a 1-hour training session on every single thing that you can learn from us in rapid fire succession. We're going to go through all of our tips, all of our tricks. It's not going to be the same as the courses that we do. Our courses are available in the Rocket Scooter website, rocket.place, or in our Discord. But it's going to basically utilize this day off to teach you things for your application. If you want to learn anything that we do, this is the day to do it. So now that we have the day off, we're going to make a lot of use of this. I'm going to give you like a minute or two to step in here, but we're going to get going in just a second. So there are some key cornerstones when it comes to trading success. There's a lot of people out there who really want to get good at trading, especially trading futures and trading prop firms and trader funding programs. So let you guys know where I am. I'm a day trader. I've been doing this since 2010. I've been doing this full time since 2015. Kind of in my 10 years, I've done all kind of stuff like competing in the Robbins Cup Global Futures World Championship. I've competed in all kind of trading contests. I recently won one in October, got first place day trading futures. There are certain things that I possess that allow me to be able to perform consistently as well as to win contests, which is really hard to do. And so what is it that I do? Maybe if that's of use to you, maybe not. But today we'll go over some of the things that I do to ensure that I can do these things. And pardon me, I'm still battling a cold, so my voice is kind of blocked. If the market is closed today, because why the Nasdaq moved 50 points, the market closes in 2 minutes, by the way. Today's presidential day in the morning for Jimmy Carter's passing. And historically, when the current president declares that day, they shut the futures market. They shut the stock markets down. Nasdaq and NYSE go down. The futures market closes at 9:30, so in 2 minutes. Overnight trading still exists because futures are a global thing. They're not just a U.S. thing. So the globe can't shut down for a U.S. thing. You'll notice that about a lot of U.S. holidays. Futures still trade through the night. But this is Friday's activity that you're seeing. So this is all still Friday's trading day, even though today is Thursday and the market's closed. As soon as this picks back up at 6 p.m. tonight, we're back to going. So this is like what you're here for, right? You're going to learn the education or get the education on anything related to futures and trader funding programs. How did I get to where I am? How do I win trading contests? How am I live funded with Elite Trader Funding? I've advanced through their program to get funded with real money. They gave me a big fast certificate that says, because of your consistency and talent, blah, blah, blah. Congratulations. This year, I'm looking to get on the leaderboard at Top Step, getting the top 20 in the world there. I'm really trying to do a lot to get my face out there. And hopefully these tips and tricks that I share with you guys can be very helpful. So today's lesson is going to be over a lot of things. Number one is going to be pre-market we're going to do pre-market setup, like basically what you do in the first couple of minutes when you get to your computer. So we're going to do pre-market setup. Let me write that down in the comments so you guys can follow. Pre-market setup, which includes overnight. We're going to do entry tricks, exit tricks, sit out tricks, like rules to sit out. Because whenever you're trading your trader funding programs, there's a risk model that's designed to squeeze you out of this account that you're in. They know what you do wrong, and they exploit the heck out of you guys. And again, you're trying to beat the casino, but the casino knows where your failure points are, and they design these things just to get you. As an icebreaker, did you know if your account has a trailing drawdown on it, you're playing a rigged game? It's designed for the sole purpose of these people sitting around a room and go, I bet you traders know nothing about volatility. Great. Let's add a trailing drawdown because that's going to be what gets them squeezed out. What is a trailing drawdown? Well, just as an icebreaker, a trailing drawdown is whenever you're making some money in a trade, at any point in time, there's like a little string attached to where you get squeezed out of your account and bust. And as your profits go up, it drags that little plate up with it. And then now your new levels to reset. And you could have made $8,000-$9,000 in a trade, and then all of a sudden you lose $3,000, and you're up $6,000, yet you've busted your account. Did you know you can avoid drawdown like that if you understand how volatility works? And so in these courses, we're going to go over this kind of thing as well. Sit out tricks for your highest probability to avoid areas of high drawdown. Future market is so S&P and Nasdaq are closed as of a minute ago. So they close at 9:30. The CME does. It's not open. I haven't checked all the contracts. Other exchanges might be open. I'm not really sure. So sit out tricks. Let me tell you something. That's the key reason that I do well in trading contests and I do well trading in life is the same reason that sometimes trolls come in the stream and heckle. Everyone always giggles because you guys have been watching me crush it for years. But let me tell you, sitting out properly, calculated, is the best thing ever. I don't know how many people have ever watched live trading. So I live trade futures on YouTube every morning. You have never, ever, ever, ever once seen me blow up an account live on stream, have you? You guys have been here for years. Has anybody here ever seen me blow up a trading account live on stream? In the 5 or 10 years you've been watching me, or almost 10 years. Anyone here? Nasdaq and S&P are closed. This is an educational session. Feel free to tell me in chat, have you ever seen me bust an account, like losing hundreds of thousands of dollars in a single trade like I'm clueless and don't know what I'm doing? Steel's like, not even close, not even close. No, that's a negative. You see me, without question, exercise discipline. Every trade I go in, if I don't have confidence, I'm saying I don't have confidence. I'm going to lose maybe $1,000. I'm going to lose maybe $2,000 on this trade. It's always known, right? So the market is closed today for the presidential day of mourning. So we're filming a live session. Trust me, you guys stay here for this entire hour. This hour, I will train you on everything futures trading. So, okay. So sit out rules are very important when to avoid the market. So we're going to do pre-market setup, entry tricks, exit tricks, sit out rules, and position and risk management and auxiliary things that you need to have with you. Okay. I'm writing it down so you guys can remember. And then, okay. All right. So those of you in chat, can you inform the people that step in? I'm trying to record this, so that's going to be continuous for people that watch on YouTube later. This is going to be uploaded to YouTube. So if you mods can do me a favor to explain to people when they come in here why the market's closed, I want to answer like 50,000 times. Yeah, not all futures will be closed because certain things are global and will stay open. But anything related to the NYSE and NASDAQ, CME group, those are going to be closed as of right now in the morning. Okay. So let me start with an icebreaker, right? How many of you out there, if you were just to take a bet and somebody were to come up to you and say, you know, like put a gun to your head and say, you get to pick one direction in the market right now. Not just say like right now, like the state of the market today, but you need to put your money in the stock market right now and leave it there for 5 years. Would you be longing or shorting? I want everybody to participate in chat because it's going to be useful for you. One of the things about the way we teach is you participate because we're actually train you. And through action and repeatability, I want you to participate. So at the end of this class, I will teach you to be thinking fast and reacting fast. Anytime I ask a question, I want there to be a habit here. Type as fast as you can the first answer that comes to your head, because what happens is your brain as a human tends to react quickly to the first thing that you lock onto. Essentially, there's a bias, and they've done case studies on kids that take the SAT. If you read the answers first and there's 4 choices and one of them just resonates with you, while you're reading the question again, you have a bias already towards that pre-selected answer. Your brain is designed to find patterns and stick to it, or find things you like and stick to it. The minute you're like, that's probably it, you're now going to read everything trying to convince yourself that that's it. So what's important is that your first knee-jerk reaction is always your most important one. And oftentimes it's the one that we need to correct. So when I tell you to pick a direction, let's say we're going to have probably like 300, 400, 500 people in here. I want everybody to get used to typing because this is going to be fun. When I go, give me an answer, and it's okay if you're wrong, because what happens in trading is a lot of times you have to process 5 or 6 rapid fire things like, oh crap, this is happening. What do I do? What do I do? And you lock up. I no longer lock up, and you don't have to be a genius to not do that. You just have to be able to be rehearsed, and you get really good at practicing this. right? So most people would pick long. I think everybody here would pick long. And there's a reason for that, right? I'm going to load up a chart and show you why the reason for that is. And I really apologize for the cold that I still have. I had another. Let me just make a new one. Okay. So why is longing the market important? Okay. Longing is very important, right? And everybody says that. So if somebody told you to put a gun to your head and said you need to pick a direction, and you said you were going to pick long, as a matter of fact, almost everybody here picks long. As a matter of fact, actually everybody here picked long. There were no shorts. So there is some merit to that. I mean, you guys aren't wrong about that. If somebody did that to me too, I would say absolutely long. As a matter of fact, on any time frame, for the most part, I would say long as long as the time frame was greater than 3 months. If the time frame is less than 3 months, it's more of a coin flip. But any basic market crash or sell-off we've had in the last 100 years really only lasts a couple of months, and then the market's back to at least finding some good bull-ups. Now, you may notice something that's really interesting here, that the market looks like it goes straight up. And I see this all the time on Twitter, and the Trading Gurus post this as well. Well, the market went up, and this is just way too high. It needs to come down and reset. This is a bunch of hocus-pocus baloney by chartists that don't know what they're doing. As a matter of fact, the market is designed to go up forever. This is what inflation does. Inflation means prices go up, and the market is going to continue to go up forever and ever over the course of your lifetime. Now, there's going to be recessions along the way, but there is no reference to previous values of the market. It's the same reason why a loaf of bread cost 20 cents when your great-grandparents were a kid, and now it's like $2 or $3. And I'm going to show you why. Very quick question, pop quiz. What is the biggest loss of financial asset value, not in the stock market, in the history of the stock market? The biggest loss of stock and company value. What year? Type it quick. Everyone take a guess, really quick. Super quick. Without being tulips. In the American stock market. 1929. You guys nailed it. 1929, right? And so let's talk about 1929. What happened in 1929, right? The stock market crashed back then. Before FINRA stepped in and limited you to 4 times your account value when you're trading on margin. In 1929, you could trade up to 10 times your account on margin. That's particularly what caused the stock market to crash over 3 years. And you're right. And this is the biggest loss of the S&P in the history of the stock market as well. 2008 didn't even come close. COVID didn't even come close. It doesn't seem like a lot, but the S&P was trading at 32 back then. It's now trading at 6,000. That's why I say the markets go up. Because of inflation. Inflation is just a thing that increases the price of something. And, the Fed tries to target allowing 2% inflation a year. If the stock market is a thing with value, it also will suffer through inflation. So 32 may not seem like a lot to you, but it's not the number that's trading at that matters. It's the percent at which it gains and loses. Your money goes up a certain amount per year in a stock market. Your money loses 2% a year, no matter what it is. And that you make more money, but things become more expensive. So reality in life, you're just converting your labor into things you buy. And that rate is relatively the same. And 100 years ago, you made less and things cost less. You had X amount left over relative to how much you made. Now, things cost more and you make more and you have X amount left over, which might seem like a lot more than 100 years ago, but as a fraction of what you make, it's relatively the same. A house mortgage is a third of your income, et cetera. A car, you do like a fifth of your income. The same rules apply. So in 1929, over a 3-year period, we went from 32, guys, to like 4, okay? That is 7/8 of a loss, okay? We lost literally almost 90% of the S&P's value. And you might say, God, that's significant, right? That's crazy. And for 3 years, it was collapsing, right? Actually, 4 years. And then it finally recovered half 6 or 7 years later during the Great Depression, and then it lost it all again. But as significant as that is, because of the exponential compounding effect of inflation on top of itself, you don't even see it on a chart. This is like the first eye-opening moment to yourself. You go far enough in time and let inflation take over. This is not the S&P going up in value. And the shorter term it is, this rapidly has to do with inflation more than anything. So 1929, you can't even see the biggest stock market crash in history. Isn't that crazy? And that's not the only crash. And I'm going to tell you why longing is important for the main reason you're siding with inflation. Multiple crashes through here. Look at this, 110 to 70. It lost almost 50% of its value in 1969. You can't even see that on the chart. Hold on, let me make it where y'all can see it. Hold on. Here. You can't even see it on the chart. 1929 is a flat line. That crash in the 60s, right here, where it almost lost 50%, is a flat line. The one in the 70s, a flat line. If you zoom in, you can see it. 120 to 60, 50% loss, just like in COVID. Yet the current value makes it to where you won't even see it. Because of the exponential nature of inflation, there will be a time where the market has moved higher 100 years from now, or 2008 and 2010. So, zoom out, 300-400 years. You're going to have crashes that are looking like this. It's the same thing. The chart aspect of staring at this saying, well, it's gone up, it's got to come down, is the silliest thing ever. Markets go up just because more people put money into them. More humans are created that put money into 401ks that buy stock. And people make more money, they put more in. They make more money, they put more in. You get raises every year, you put more in. Average salary goes up year over year over year. People are putting more dollars into the stock market. So the value of the stock market just goes up despite supply and demand on inflation alone as well. And it will exponentially go up forever. So one thing you'll do as a starting point to your day is never look at something like, well, God, man, we're due for a recession because of this. Anytime somebody teaches you that, ask them to show like a 3-year performance report and ask them if they actually really trade. This is the silliest thought in the world. I could show you there are dozens of crashes you can't even see anymore just because of the nature of this. Most companies in the S&P, here's a question. What percent of companies in the S&P go to zero over time? In the history of the S&P, this is a pop quiz. What percent? How many companies go to zero over time? On average. All. This is your first mic drop moment. All of them. Every company eventually goes to zero, roughly. Every company that existed in 1929, 1939, 1949 is likely, very few of them are even part of the S&P anymore. The companies that existed in 1600, 1700, 1800 are no longer around. Whatever it is, most all companies go to zero. They get delisted and a new one takes their place. So almost the entire history of all companies that existed no longer exist anymore. The index is its own entity despite the companies inside of it. Who knows in 300 or 400 years what the 500 companies would look like? Maybe none of them that we have, maybe Apple and Meta and all these won't even be a company anymore. You don't know what happens over time, but the thousands of companies, or millions of companies that have existed as part of the S&P, the majority of them are no longer in business. Not because they go bankrupt, but because they get evolved, they get purchased, other companies step in, and there's always a new batch of 500 stocks rotating into the market. So as in reality, it's not that all companies go bankrupt, it's that all stocks practically go to zero, yet the stock market goes to infinity. And this is one of the key takeaways, especially for you as a futures trader, to write down. I want you guys to get a pen and paper and maybe write down some of this, okay? Need to think of that, right? The stock market goes to infinity. That's where it's going, to infinity. Currencies do this. They always go up, right, when you have inflation. But it's healthy inflation. But all stocks go to zero. Every individual stock that you own is more likely to go to zero than it is to go to infinity as well. Pretty neat, right? Okay, so with that being said, as a futures trader, you're tracking the index. There's always 500 strong companies that are inflating in value at any given time. And the index pretty much always goes up to a degree that staring at a chart should never tell you that the market's going to come down. So this is a course on why charting's kind of silly, why it produces strange phenomenon in your trading activity. And I'm going to give you a tried and true trading strategy. Our courses teach this, but I'm going to drop the mic for you here and teach you this. I wrote a program and we share this. We have a 20-day profitability mindset masterclass that goes through every single thing in the stock market that we teach about, in the futures market that we teach about. Every single thing is in that class. And we start off that class by giving you a guaranteed trading strategy. It's guaranteed to work. It's absolutely guaranteed to work. It's never failed in the history of time. Now, I can't promise you that a trading strategy will work for you. Obviously, legally, I can't. But as an engineer, which is my background, and mathematician, the goal is to provide like a baseline for you to make all of your understandings of. So we provide this hypothetical scenario of a trading strategy that has worked at any point in time 100% of the time. And I've gone back hundreds of years and it hasn't failed. This is a winning trading strategy. It works. Would you guys like to know it? Here's a winning trading strategy. In our classes, they build on top of each other, but we start with this framework. And the reason we give you this is because it's designed to teach you the flaws in your own application of trading. Okay? And don't forget to hit that like button, you guys. This is a guaranteed winning trading strategy. So many people use it, and you make a lot of money. Here's what it is. We pose this question to you. If a gun is put to your head, what do? You had to choose right now to plant your money for 5 years, do you long or short? And despite the market going straight up, everyone said you would long. And to your surprise, that is the winning trading strategy. And this is, again, done as a framework, as a baseline to weed out problems you're facing. And actually give you real trading, applicable trading strategies. It's not something you're actually going to do, but it's something that mathematically works. We said that if you take a dartboard, and I wrote a computer program that went through every scenario and proved this. And we have a friend of ours, is a blind monkey. He can't see, but he can do things with his hands. So he has a bucket of darts sitting by his feet, and he throws a dart at a dartboard. And the dartboard is divided into sections, and the sections are like a clock, 9 o'clock, 10 o'clock, etc., all the way to 4. And all the monkey has to do is throw a dart at the dartboard, and wherever it lands, the monkey longs the market at that time, and that time alone. One handle that the monkey has that they can take advantage of despite this randomness. And the handle is as follows. The size of the position, and you buy S&P anything, S&P futures, anything, a stock, whatever, you buy, and you hold until the end of the day. You have one stop loss that is calculated every single day to be a certain amount of stop, such that after 20 consecutive days of losing, and this is the best part, 20 losing days in a row, meaning that you lose every day of a trading month. There's 20 days in a trading month. You lose and 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 you lose. Like a red month where every day is selling, most every day is selling off. Okay. So every single time you lose a certain percent of your account, so that you're not allowing yourself to blow up when you lose by the end of the day. You stop after a certain fraction is lost. And you design that fraction where after 20 days of losing, at the end of the month, you still have half of your account left. This is the mic drop. So you've had the worst trading month ever. You lost 20 straight days, and now you still have half your account. And say you do it again, and you lose 20 days in a row again, and now you're down to a fourth of your account. And you lose 20 days again, and you're down to an eighth of your account, et cetera. You never go to zero, but you keep losing. Just longing the market. This really doesn't happen because a couple of cool, neat things happen. But let me tell you the outcome of this. If you allow yourself after 20 days to have half of your account remaining by the end of 20 days, and you just randomly long the market, and all you did was adjust your position size to be smaller as your account got smaller and bigger as your account got bigger, did you know this is one of the most profitable trading strategies in existence? This not only makes money, it makes a lot of money. As a matter of fact, this is designed to ride this wave exactly the way that it is. I'm going to tell you the stats to prove that. But randomly longing the market, and all you do is adjust your position size, you will make so much money over the course of 50, 60 years. You'll be wealthy at the end of 60 years, randomly longing the market, randomly. Wrote a computer program that did this. At no time did my program blow up this account. At any time, as you extrapolated this further, or at any point in time, it actually makes money. A whole lot more than you started with. Is that cool, right? So why do we create this guaranteed trading strategy scenario? And it's to teach you one thing, that it's not where you long or what you did to choose to long or where you shorted or whatever. It's not the indicators you use. It's not the recipe that you use. It's not even when you get in the market that matters. The trick to making money over time is just not losing the money that you have. And so this was posed by us as a thought experiment to set a baseline to teaching trading to people. So the idea is that over time, you make money because you didn't lose the money that you had, all of it. Because over time, the market has bumps along the way, but the market exponentially grows and your account will exponentially grow. Don't worry if you're down to an eighth of your account. That eighth will eventually compound over hundreds or 50 or 20, whatever years to give you almost all of your gains back. It's not hard to think, but let me teach you something really neat as well. Say that you lose, you start off with 100K. And this is kind of an interesting thought, and people don't really think of this. But say that you lose half of your account and you're down to 50K, right? So when you lose half, one of the things that you do is say, oh, I just need to make 50K back. I'm down 50K. Let me make 50K back. And this is the mindset that is toxic to traders. Stop thinking of the value of the money that you're losing or the amount of points that you're losing, whatever. You need to think in percentages, because the reason why 1929 is a flat line and the 60s crashes are a flat line, and over time, the 2000 crash will be a flat line, given enough, because the market is moving on percentages. It inflates a certain percent a year. So you need to think of percentages of your loss. When you lose 50% of your account, you don't need to just gain $50,000 back to get even. You actually need to gain 100% gain to get even. And a lot of people don't wrap their head around that. The idea that you lose money, you almost have to work twice as hard to climb your way back up. It's the craziest thing to think about. If you go from 100 to 20, right, you've lost 80% of your value of your account. You guys know how much percent you need to get back to being even? 400%. You need to make $20 4 times over. So every 80% you lose is a 400% grind to get back on a percent basis of your account. It's why, like, and I'm gonna poke fun at some influencer, and I'm not gonna name a name, but some influencer right now is peddling a garbage trading coin, right? And the trading coin has literally lost like 97% of its value, and literally has done this. And then one day it had an 18% gain, okay? And the influencer's like, to the moon, baby, this is generational wealth, okay? So let me teach you something about losing 90% of its value, okay? If you were to long here and lose 97% here, you have 3% left, okay? This 3% you need to make 33 times or 34 times minus the one you have. So 33 times. You need 3,300%, that's a percent, to get back to break even. What investment do you know of that has gone up 3,300% in the stock market? What? Something to go up 33 times its initial value or its bottom value? So let's talk about the bottom in 1975. So the $60 to go up 33 times, right? So 33 times 6, 1980. So that's about what, 1980, right? So how many years did it take you to recover 97% you lost, and on the 18% up from the bottom, you think it's going to the moon? How long did it take to go from S&P 62 to 1980 S&P? When did S&P hit its value? So that bottom was in, 1975, and we didn't hit 1980 until 2017. So good luck to you waiting 40 years to get your 33% back. See, people don't think when you jump into scams and garbage out there, it's not a loss till you sell. Somebody said that's the funny joke. 1975 to 2017. It's 42 years. This is not going to the moon today, tomorrow, this year. Your great grandkids might benefit from your penny stock. People are not understanding the percent growth it takes to recover massive amounts of loss like that. So don't get suckered into meme coin scams, guys. That they can't be like any more solid about that. The percentages are crazy against you, right? So don't listen to value or it's gone up and needs to come down. I've taught you that the markets move in percentages, and this is what's very important. Okay, cool icebreaker, right? So randomly longing the market and controlling your position size is actually the key to making money as a trader. The first rule of thumb you always tell yourself is the way to make money as a trader is to not lose money as a trader. As long as there's something in your bucket, that loss will eventually compound over time. And even if you've lost 97% of your account, right? We said it takes about 45 years or 42 years. 97% loss of an account will take roughly, if you just look at the S&P, it's like 45 years to get back to break even. Okay, well, you're still alive there, right? But when you lose half in the blind monkey scenario, half, let's count how many times you have to lose half to get down to 3%, right? So this is 1 out of 33. So 1/2, 1/4, 1/8, 1/16, 1/32. So roughly 6 months in a row of losing 20 straight days, like longing the market, 20 days. For 6 months, like you have 6 red months, which never happens, by the way, but you will recover 120 straight red days in a row. In 45 years, you'll still break even because that's a third of your account, or sorry, it's a half of your account compounded for about 3% of it left. As long as you keep having a little bit left, it's only the amount of time before you break even. But here's the best part of this. We went back and counted, and our members put together a little PDF that's available in our Discord. And the PDF actually does this. If you count back the last 10 years, what's really neat is that on the monthly scale, 70% of candles are green, and only 30%, give or take, are red. This is a very important thing to know in that scenario. That, as I showed you, if you last half your account, and you only had 3% left, and you're just randomly longing the market, it only takes 45 years to break even. Lucky for you, you're not going to lose that much that fast with that strategy. Now, again, it's not a real trading strategy. It's hypothetical to prove to you the numbers that are in front of you. But yeah, if something's lost 97% of its value, you're going to be waiting 40-something years just to break even. So don't listen to people when it jumps up 18% off of its 97%. It's 18% of 3%, by the way. That is all that you actually grew on your loss that you took. So don't listen to these things. Think percentages your whole life. Okay, so 70% of months are green, which is great because in this scenario, you kind of don't want to lose 120 days in a row to have to fight back 40-something years. But you go back and count your monthly candles. This is the SPX. You're rarely going to see red month, red month, red month. Even in the recession we had in 2022, 1, 2, every other month was green pretty much on the way down. The worst you had was 2 red months. COVID was 2 red months. The flash crash was 2 red months, and you had 2 red months and 1 recovery. Even the worst financial disaster in the history of your lifetime, you had maybe 5 red months in a row, and before you had some green. 2 red months, and then the crash was here. You only had really 3 months of loss before it recovered. So your goal as a trader is not to pick the right direction of the market. It's to survive this and have a long-minded mindset more often than you have a short-minded mindset. Because over time, you're ultimately going to win. And I'm going to tell you a couple cool facts. Did you know, on the way down, let's use 2008 as an example. On the way down, you might notice something about these red candles. More often than not, red candles will have wicks on the way down, even when the market's crashing. Isn't this crazy? As a matter of fact, every one of these months has a wick, which basically means on the month scale, the last week of the month, people are buying it up. And so of those 70%, like I said, we did a study of those 70% of candles in the last 10 years. Did you know that, so this is green and red. This is a great thought, okay? So we're going to reshape your brains today. Of those 70% of candles, did you know of those 30% that are red? So go count them. You'll see that there's more green than red. Of those 30%, roughly 60% of those 30% regain a third of their loss by the end of the month. So the last week of the month rallies. That's neat to see. And you can look at all these red candles. Markets sell off for the month. you're usually going to regain a third of your loss. Very rarely do you have a red candle that closes red. It's a really neat phenomenon, especially when markets are crashing. There are still buyers on the way down. We could prove that to you with a chart from the Commitment of Traders, which we'll get into later. And if you didn't know the Commitment of Traders was a thing, welcome to learning about futures. Commitment of Traders is a positional distribution of futures. And so this is the thing, and I'll teach you guys this another time, but you can actually see how asset managers and hedge funds and things are positioned in the futures market. And you could see that, over time of market crashes and things, that even in, the 2023 recession we had, you can see that as the market's dipping, this green line is becoming slightly more green. This is the net position of asset managers. People with 401ks, mutual funds, IRAs, things like that, your retirement account is in this asset manager group. So while there is a recession, you're still funneling money into the stock market with your daily paycheck or your weekly paychecks. So you can see that even when markets are dipping, there's still more people longing a lot of the time. Markets selling off in the 2022 recession. This was not the recession, sorry. This was the Fitch downgrade. This is the recession. And even as markets are falling, you can see that there are waves of buying as the market goes down. There are people that take the blind monkey strategy. Yeah, some firms are taking profit, but other firms are entering the game or dollar cost averaging in to get something at a better price. Do we all see that? Markets there's always people buying no matter what environment you're in. And that's part of why those red months wick out. Does everyone see right here where I'm circling? It's like there's waves of buyers, even though there's ultimately like over time, the majority of people are selling, but there's still waves of buying on the way down. Because there are people that are like, well, I'm managing retirement and I need to make gains over time. So anytime it's cheaper is advantageous to buy because I'm going to bet that the stock market does this over the course of this client's portfolio. Markets are going to go up. And so because there's always buyers, when markets dip, especially in crashes, 60% of those 30% wick up at the bottom. So let me give you some cool stats. And on the other side of the coin, if you were to count the green candles, so let's put those numbers again. 70% are green, 30%, and this is the month scale, 30% are red. Of the 30% that are red, 60% gain a third back. Okay, it's incredible how much people buy when markets crash. It's insane. Of the 70% of market months that go up, did you know that only roughly 20% lose a third? Very important for this stat. Again, the blind monkey very much benefits from this stat, meaning that green candles tend to stay green. They don't really wick down. On big green months in the last week of the month, your thought is not like, let me sell this off. Do you see at the end of the calendar month, green candles don't really sell off much. Very rarely do they do. Your green candles, as a matter of fact, they tend to close closer to the highs. So if I was asking you again, do you feel more confident now in your initial decision? If I said, somebody put a gun to your head, pick a direction, up or down. Now do you understand a little more mechanically, not just because the stock market shapes like this, but now we're looking at the month scale. Do you feel more confident that just randomly longing the market is beneficial as long as you control how much you lose? Like I said, we're building a trading strategy live. You guys ever hear musicians that like use a loop pedal and they do the drum beat and then they loop it, then they play the guitar, then they loop it? We're building a trading strategy before your very eyes with this framework of that hypothetical study. Now with knowledge, and again, do this for yourself, but in our classes we go through and do this. And this is kind of like a summary of our 20 classes. This is the first one. So as you see on the month scale, the majority of candles, so 70 times 80 is 56% of candles are long and strong and green without selling a third. Okay. 14% lose about a third. This is total. 18% of red rally in the last week. So the last week of the market rallies the sum of this position at the time. This is the selling, 30 times 60 is 18. So that's the red month that gains back a third. This is the green month that loses roughly a third or less, but still green. And then this is the green month that doesn't lose a third. So 56 plus 14 plus 18 is 88? 66, 70, 88. 88% of months in the last week of the month are likely to only be falling roughly a third or slightly less, like this one, rallying. So the overwhelm, and if you were even to exclude the amount that does, like the green candles that do wick out, 56 plus 18, 56, 66 is 78. Sorry, 74. So this is the percent of candles that don't lose a third that are green or gain a third back that are red. 74% of market months rally significantly in the last week as you go count the candles. So yes, randomly longing the market is extremely beneficial, as somebody said, because of these facts. Historically, this is anecdotal, but that's it. Now let's go to the day scale. And I like to have fun with this one too. We're going to pick, and we're going to do this, again, we do this in our classes. I want you guys to pick any recession. And the first person that picks one, we'll go through it. Like pick a time frame, and we'll analyze that recession really quick. Now we're going to look at the dailies. We're zooming in on lower time frames now. So we started off with the overall hundreds of year history of the market, why it goes up. Now we're looking at the monthly stats of why it goes up. Now we'll look at COVID. Okay, we can look at COVID, but let's pick something that has more data points just for more effect. COVID's very quickly. Let's do 2008. Okay. So let's pick a nice little solid bull run, and I'm just going to zoom in here. All right, we're going to show you something really cool. All right, let me just pick, I don't know, let's just start here at the bottom. Okay, so this is the base of the 2003 crash, and this is the high. When I just look at the chart, you can clearly see that it looks like it's a lot of green and it looks like it's a lot of red, right? But let's go here and just count these candles, right? So on the way up, you expect more green than red, right? So let's just count them. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 18, 19, 20, 1, 2, 3, 4, 5, 6, 7, 8, 9, 30, 5, 6, 7, 8, 9, 40. I'm just going to make a mark here. 3, 6, 9, 50. 1, 2, 3, 4, 5, 6, 7, 8, 9, 60. As a matter of fact, we can keep going, but I don't want to be counting all day. This is about 60 candles from here to here. And again, it's going to be the same if we keep going, I promise. Or green. This is daily candles. Now red, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. 3, 4, 5, 6, 7, 8, 9, 30. 1, 2, 3, 4, 5, 6, 7, 37. Now, again, it seems like an overwhelming amount, but let me give you the total stat because we've done this over hundreds of years as well. 60 candles are green and about 40 candles are red for every 60. So roughly 60% of bull run candles are green, and that matches the stats that we normally count. You're going to say that in bull markets, 50 to 60% of the daily candles are green. So the monkey is benefiting from the idea that they're not going to lose 20 straight days in a row randomly longing the market. Because every other day, as a matter of fact, every 3 out of 5 days, they're going to be profiting, hopefully. Does that make sense? So to lose 20 days in a row, like the original blind monkey strategy, we'll call it the blind monkey strategy, is almost impossible to do, as more than half the candles are green. Isn't that cool? So as long as the monkey picks a bull run, they're not going to lose half of their account every month. They're not going to get anywhere close. They're probably going to gain money every month. So the question is, what happens if the monkey picks here? And they do this amazing bull strategy at the wrong time, right? So as we showed, if the monkey were to randomly pick a month to start, 70% of those months are going to be green and not sell anything. That's a great strategy for blind monkey. So let's start putting some stats up here. Blind monkey is going to win 70% of their months. Pretty cool. And if they pick a bull market, the blind monkey is actually going to win 50 to 60% of their days. Okay. So as you see, just randomly longing the market, you're not going to lose 20 days in a row. Do we all understand that so far? So that's what this is trying to prove. Again, we're building a trading strategy in front of your very eyes off of randomness. And then I'm going to give you some stuff that works very well inside of that. Okay. What happens if they pick a bear market, though? So you can say, aha, but what happens when markets are crashing? in a bear market. So let's just go here and let's zoom in on just right here where the market was crashing. Now, you may say, well, I'm sure it's probably 60% red candles, and you know, it's probably going to tilt the other way. So let's start at the very top. Let's be fair. Top to bottom. Let's count these crazy red candles. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Oh, I'm sorry, this is a weekly. Starting to go to the dailies. Let's see. Let's see what daily candles look like in 2008. So starting at the top and going to the bottom. Let's count these amazing red candles. And again, let me just, unless you guys want to watch me count the whole thing, which I guess I can, but let's do it. 1, 2, 3, 4, 5, 6. Oh, let's count the red. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. 5, 6, 7, 8, 9, 30. 1, 2, 3, 4, 5, 6, 7, 8, 9, 40. 1, 2, 3, 4, 5, 6, 7, 8, 9, 50. 60. 1, 2, 3, 4, 5, 6, 7, 8, 9, 70. 1, 2, 3, 4, 5, 6, 7, 8, 9, 80. 90. 1, 2, 3, 100. 10. 7, 8, 9, 20. And then, you know, I mean, let's just start with this and we'll do the crash. I'm tired of counting. 120. Okay. Take note of this. 120 days from 2007 until the end of 2008 was the bear market. And then the market crashed here. This is the market crash, by the way. The crash of 2008 was a bear market that finally crashed. And a crash is such a small thing. Typically, a crash is going to be less than a month on almost all time frames. As a matter of fact, this crash is 1, 2, 3, 4, 5, 6, 7, 8. 8 days of crashing. Other than that, it was just a bear market that's trending down. And counting from here to here, I'm getting tired of counting. What was it, 120 days, right? You want to count all the way to the bottom. But we counted from here to right before the crash. And I'll do the crash separately. Okay, so 120 red days. And so let's see how many green days that we also had inside of this run. Showing at the top. 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 2, 1, 2, 3, 4, 5, 9, 3, 1, 2, 3, 4, 5, 6, 7, 8, 9, 4, 5, 6, 7, 8, 9, 5, 2, 3, 4, 5, 6, 7, 8, 9, 6, 1, 2, 3, 4, 5, 6, 7, 8, 9, 7, 1, 3, 4, 5, 6, 7, 8, 9, 80, 1, 2, 3, 4, 5, 6, 7, 8, 9, 90, 1, 2, 3, 4, 5, 6, 7, 8, 9, 100, 1, 2, 3, 4, 5, 6, 7, 8, 9, 110, 1, 2, 3, 4, 5, oh, you can't see on my screen, 6, 7, 8, 9. There's over here. So 119 green days and 120 red days. It's eye-opening how much you guys need to know the stats of how often something happens. So, because we're proving somebody, and everyone in chat, if you can help the new people that stumble in. So, if 70% of months are green, and in a bull market, 50 to 60% of days are green, in a bear market, 50% of days are green. Isn't that crazy? So as we pose a strategy that my computer program that showed a blind monkey longing the market at any point in time is likely to go up if you're trading per day. So the stats of longing the market are just so beneficial to a trader. 70% of, if you pick the right month, 70% of months will go green. If you pick the red month in a bear market, every other day is still going to be a winning trade if you randomly long the market. So counting the number of days just to prove that to you guys. Market goes up, you get it, but on all time frames. And so the idea boils down to you didn't know that the crash that was 7 or 8 days is the reddest part of that market. So you guys get it, right? We just proved the market goes up pretty much in all time frames. So that's why the blind monkey strategy actually works, because every other day you're likely to win. So even if you're not going to lose 20 days in a row, you're probably going to lose 10 in any environment. And over time, the idea that there's a slight tilt to the bull side on both the monthly and the daily scale, the monkey makes money just by not losing their trading account. And that's the framework. It's not market goes up. It's that you make money if you just don't lose it. Automatically, you just randomly long the market and it's going to win. And again, the computer program we made proves that. And these are the facts why. So what's really neat about that is that over time, it teaches you what you're doing wrong, and all of you guys are doing wrong. How can somebody make money randomly longing the market and longing when markets are falling, and yet you're doing all this extra work, journaling? How many here journal, right? Looking at charts, doing hours of homework every night, all of this work, and yet you're still losing money. And all you need to do is wake up and put a blindfold on and throw a dart at a dartboard and just long and go about your day and make more money than you ever did day trading. It proves a point. It's not that you're going to go get a blindfold tomorrow. It proves a point that what you think you need to do is not what you need to do to win at this game. So as somebody who wins at this game, I'm going to teach you that this is the proof as the only thing that matters to save your ass and make money as a trader. This is the rule. Position size. That's it. This is what the monkey did to survive. If you are losing money as a trader, it's not because you're using the wrong concoction of indicators, the wrong recipe, the wrong guru stuff. You're not going to magically stumble onto indicators that are going to make you win the market, because I already showed you how you're going to win the market. You're just going to wake up and long randomly. But you have one thing you got to get good at, which is the only thing that makes that strategy work, which is position size. And would it behoove you to know that that's the only thing that makes any trading strategy works, which it means that any trading strategy you do use that is not working, the reason it's not working is not because your trading strategy sucks. Most indicators and technical indicators have been proven by many different studies to be very sophisticated coin flips. MACDs, VWAPs, Fibonacci's, they work 50% of the time. They don't work at all. They only work when a lot of people are using them, and as time goes by, computational methods and quantitative liquidity providers have overwhelmed the market, with the majority of orders just being supply and demand and liquidity providing. There's not anybody using charts anymore at the highest level of trading. It's only a retail thing that's holding on to like techniques from the 70s. These days, everything is done mechanically, and I'm going to promise you something. Citadel isn't routing orders by looking at a chart, putting indicators on it. It's real-time supply and demand quantitative metrics they're using, which go well beyond the technical indicators that you do use. So your indicators are a failure, all of you. All of your indicators fail, every single one of them. They don't make money trading. But the people that do make trading have this magical ability to size their position correctly to ward off the amount of loss they do. So there are two things that you can do tomorrow immediately. Actually, there are three things that you can do, and I'm going to teach you how to do all three of them today. That actually can change things. Now, if you guys, I'm going to ask the chat as people here watching me trade. I'm going to ask the chat, so I'm not selling you anything. What is my average win rate as a trader? Can somebody tell the group, which you've witnessed me live trading, my win rate? Somebody type it. 95, geez, that's high. 70 to 80%, as people are saying. They've seen me have 80% months, 70% months. You go to my Twitter. I did a trading contest in October. Over the month, I had 80% win rate as well, with like 1,400 trades. Not because I have a crystal ball, but because I'm a position sizing master, I can turn a losing red day that does this, if I longed wrong, it just moves to there and usually break even on days where I pick wrong. Like I throw the dart at the wrong spot. Now, I'm not randomly longing the market. I have a very sophisticated way of getting in, But the things that really matter are position sizing for the risks that you're taking. Okay. Position sizing. The three things that matter: trading where there's only going to be volume, which means picking the right spot to enter in. So we're going to take instead of just randomly longing at a time, we're actually going to use some strategy now. So we already talked about position sizing being the way that the monkey makes money. So the two other things that matter are, let me only trade where volume is going to be. Rocketsuiter is a platform that's designed to sniff out volume. We have 15 different techniques that we made that can predict volume. And I say this with a smile. We're about to do an experiment. I can predict volume. See, the stock market is random. It's random noise. And famous, most successful hedge fund manager in the history of time, mathematician Jim Simon, said the same thing. Market is an aggregate of nothing more than Brownian motion, which in physics world or engineering world, Brownian motion just means random fluttering. It is. Humans making human decisions is all random. Price action is random, and therefore your indicator is output is going to be random. Random just means the outcome can't be determined. A coin flip is deemed random. Random doesn't mean 50-50. Random just means you can't know the outcome. Even if something's 80% probable to happen and you can't see that, you can't see the outcome, it's still considered random. So the market is random because you can't predict what humans are going to do. You don't know how much money they have. If they're a margin call, do they have to sell, or is their buddy going to loan them money? Because you can't see past the veil, all of market price action is random. Okay, so every indicator you're using is relying on the other three things to get by, or the three things to get by: position sizing, volume, and avoidance, days to avoid market. How I achieve up towards 80% win rate sometime is when to avoid the market. I have the best crash detectors, volatility detectors on the planet. I avoid so much crap, so much chop, so much nonsense, and I only participate when it's in my favor. So I take those blind monkey stats and I go way into my favor by avoiding the majority of the noise. Markets are crashing. I'm not still there randomly longing the market. I avoid most of it. As a matter of fact, during COVID, there were 3 straight weeks of market crashing where my avoid detectors went off and I didn't even touch the market. So I even made the strategy even better by knowing when to sit out. So if upping your win rate is something you want to do, that's what these classes are designed to do. This is how we up a win rate, okay? And I'm going to tell you something that's going to break your heart. There's like a fourth thing here. Position sizing, trading only when there's volume, no avoid market. And number 4, you're going to short less. And I'm going to tell you why. Well, we already told you why. But you're going to short less. Because at the end of the day, the idea that statistically markets go up, you're not benefiting from fighting the trend. So now what we're going to do is try to stack the odds in your favor everywhere we can go. Position sizing was how the monkey made money. Longing is how the monkey made money. Avoiding those crash months so that you're not losing half of your account in the months that do go down. And then trading when there's volume. So not every price matters. But if you can prove there's volume, then you can prove that you got in at the right spot. Your drawdowns are going to be less. So we use sophisticated methods to find volume. While price is unpredictable, volume is not. Volume is 100% predictable. There's 1,000 ways you can do it. There's a bunch of neat mechanical things that go on in the market that you didn't even know. Okay, so we're about to improve on the random longing strategy by giving you some metrics to go with it. Okay, so far so good, right? Position sizing and risk management. Well, position sizing falls under the risk management category. Is how you actually do make money as a trader using proper risk management. Now I'm going to give you all the tips and tricks I use. Okay, so shorting less and having the appropriate position size, or at least taking the appropriate loss, is how the monkey does make money, by longing only and choosing how much they're losing. As a matter of fact, that's the one thing you do have control over, is how much you lose. You don't have control over how much you win. The market is random, but you can choose when to pull the plug. Okay, so going forward, right? Let's go back to showing you guys what we had on the screen. Where can you find volume, right? And when can you avoid the market? Are very helpful. Now, as a technical indicator, let me explain to you why technical indicators fail. You might not have known this, but a technical indicator is just a function of price. Candles like flutter up and down, and people take this data and put it into a function of price, some math equation, and then candles output some kind of indicator on their chart. Now, again, A moving average is a simple representation of this. You average out so many candles into this data point, and then you create an average. So what you're basically doing is you're taking price and converting it to something else. So the idea is now you have two moving averages that cross over, right? And your brain may say, aha, well, that's a long signal because these things crossed over. And markets are just trucking or like this, and then all of a sudden there's a rally and the moving averages crossed over. But see, the thing is this is based on this. So this has no way to forecast this. If it did, because this is built from that, then it means this can forecast itself without it. If you take this and convert it and it predicted what it's going to do, then you didn't even need to convert it because this delayed the effect even further. So what you're saying is price can imply that it goes up. If a technical indicator implies that price should pivot here, then it means price is self-predicting. It's like saying, I'm going up and I'm going to continue to go up because I say that's true. So it's like in logic arguments, any self-referencing confirmation of validity is immediately seen as a logical fallacy. You can't say this is true because I say it's true. You have no authority to validate the authenticity of something. And not to ruffle anybody's feathers, but again, we're kind of like taking a neutral tone here. But in religion, this is the biggest logical argument that people have in the religious space. They say these are the rules that my religion says we should follow. But somebody says, yeah, but your religion tells you that it's true. It's inside. The book says, believe me because I say believe me. You need an outside authority to that system that people are saying, where's the outside authority? And then people say, well, I believe there's a God. Okay, then now the authority is based on a belief. So again, I'm a spiritual religious person myself, but just saying the argument, a logical fallacy. Something isn't true just because it says that it's true. In logic, you can't make that assumption. In mathematics, you also can't make that assumption. So that's the easiest way people understand it. So you need an outside thing. If God walks in, basically the reason I say is probability. If you look at a book and half the people are like, yeah, it's maybe true, half the people are that it's not true. See, that's the split proves it's a fallacy. But if God himself walks in and says, hey, it's true, 100% of people will agree. The outside authority is the validation of the closed system. And this is a mathematical thing, by the way. But that's how it was described to me in my engineering school by my professor. So you can't self-validate. So therefore, technical indicators can't work because it self-validates price. If price went up and the indicator goes up and this implies this should go up, then because this implies that, then price should go up again, which means indicator goes up, which means price goes up, which means indicator goes up, which means price goes up, and indicator goes up, which means that anytime this goes up, that needs to go up, and therefore price would immediately achieve infinity overnight because up means up, and price should never come down. But it does all the time. So therefore, this has no predictive power for that. As a matter of fact, no technical indicator has any predictive power over price because price is random. Therefore, if price is random, so is the indicator. And so you can't self-reference any validation to a strategy. I'm going to guarantee you that any technical indicators that you use are going to roughly be 50-50 chance. The only survivability you have with them is not trying to bet on the direction of the market with them, but it's still know how to size your positions correctly around it. So the idea is that it's not what you're using that's going to help you out. Now, why is volume important? Because if you were out there to buy anything and somebody says, hey, there's a bunch of houses that are worth like $1 million, okay? And then there's one house that's listed for like $400K. And all the houses around it for $1 million. You can put some work on that house. Oops, I mean to draw a line to that. And flip it. Hey, buy it from me because you can flip it. And your brain can say, hey, that is a good value. Maybe I can flip it and make $300K off of that. But the thing is that there's one missing piece of that equation. You didn't say, why are you having a hard time doing that? Why aren't you taking that amazing investment? It looks good on paper. The amount of money I'm going to make is good. But there's one missing piece. It's that to liquidate that asset and make the money you're going to make, you need to find a buyer to come in after you. You didn't ask yourself how liquid that market is to make that decision. Liquidity is a very important piece of winning as a trader to understand where to find liquidity. There's a lot of concepts out there that are all about finding liquidity. Everybody knows like ICT, smart money concepts and things, all about finding liquidity. Liquidity is the thing modern traders need to understand how to find. Now, this is, of course, on rocket scooter stuff. We don't use those kind of concepts here, but we find different ways to find liquidity. Where are buyers, or in general, where are traders going to be? If you didn't ask the question, is how often are houses sold in this environment? And people would say, well, there's a train nearby, or there's fires all the time. And it sucks to hear there's fires going on right now on the west side of the country. But something bad is happening, and it's going to be hard for you to sell. So you might be locked in a good monetary investment, but you might not be able to find a buyer for like 5 years because of some kind of other thing you're not paying attention to. The market could be highly illiquid. So you're not just investing in value of something, time also has a value. And the 5 years it took to make that money is 5 years of loss you could have taken, that you're taking by not making another investment that's better, that's more liquid. So this is not necessarily a value if you're not asking yourself, when can I make my money back? If you can guarantee that there's hundreds of buyers lining up, that's a great deal, because you'll flip that house in a matter of days, if not weeks, the minute you list it. So does everyone agree, at least for now, that the most important part of at least that example of you buy something that's going to go up in value is you kind of need buyers to come in after you? Do we all understand? Yes, if you agree, type yes. Makes sense? So again, we're building on the blind monkey strategy to actually build a trading strategy live in front of your eyes, right? Makes sense. If you can say there's 5 buyers, okay. But if you can say there's 1 million buyers, the 1 million buyers scenario, which neighborhood has 1 million buyers, is more important than the 5 buyers. As a matter of fact, your brain will say, I have 1 million buyers. I could probably get more than 1 million out of this. I can prove that there are people looking at the houses at a magnificent rate. That's where I want to participate. Here, 5 buyers, I don't know. I need overwhelming demand, right, for the supply. If I hold the lack of supply, there's one house that everyone wants to buy, then if I control the supply, the only house for sale, then I can set the value. So one of the key rules of liquidity is, if you're writing down, taking notes, he who holds all of the inventory sets the price of the market. And this is true with like crap, meme coins and penny stocks. Whoever holds the majority of something influences price directly. The best way to think about it is think of your favorite concert ticket. You want to buy a ticket. They're all sold out. And the scalper in front of the arena has the only ticket available, right? And it normally costs $100 and he wants to sell it to you for $1,000 because he's got the only supply that's left. That supply and demand imbalance is why things are so expensive. It's why scalping concert tickets is expensive. It's why illegal drugs are so expensive, because the supply is not unlimited. The supply is throttled. It's why diamonds are so expensive, right? So people have this ability to control the supply. They can set the price, okay? So that is an illiquid market. Illiquid markets move rapidly in one direction because that's what happens. That's why penny stocks go through the roof, why meme coins go through the roof. There's actually not a lot of liquidity in those environments. So liquid markets, right? It's a very important thing to note is that liquid markets don't necessarily crash. And I'll bring up one more specific chart to kind of prove this to you. So your job as a trader is to find liquid markets. The commitment of traders for S&P futures shows the 4 major reportable categories. They report to the CFTC every week. And if you didn't know the commitment of traders was a chart, you're welcome. This is the best chart you could have on the sidelines to understand the state of the market that you're in. There's 4 categories of institutional reporting positions. You as a trader or trader funding program trader are not in any of these categories, but hedge funds and in ETFs and things like that who invest large amounts, asset managements, they have to all report. Market makers, they report. 4 categories. The long-only side of the market, which is your 401k pensions, mutual funds. The short side of the market, which is this blue or purple, are hedge funds. And this is the market makers. This is a key point of the market. And so this is the total net long position they have as of today. And I'll show you a couple of really cool facts to teach you why liquidity is the most important thing that you're going to look for in the markets. The commitment of traders will prove that. So liquidity means there's available buyers and sellers nearby, right? If I were the only seller of that house, I can jack up the price to tens of millions of dollars if 1 million people want to buy it. But if there's a lot of houses for sale and a lot of buyers to buy them, well, a lot of sellers and a lot of buyers mean that it's liquid. As a supply owner, I don't have the flexibility to jack the price up to infinity because I'm now on a price war with my neighbors. And also, because the lack of demand is not there because there's a lot of buyers, I can flip the house relatively quickly. So liquid markets tend to come to an agreeable price faster. And so the neat thing about liquid markets is the price protection prevents it from crashing because there is competition between sellers and there is demand between buyers. That phenomenon will keep the housing market, in that particular example, from crashing. So you can see the same thing in futures. So this is S&P futures. This is the price of the S&P futures as they go up. This is how the distribution of risk happens. And so liquidity, when buyers and sellers are nearby and agreeing. So one of the neat ways to find liquidity is to compare on this bar chart version, the blue and green lines. So anytime the green line is going up, it means there's more people longing that next week. And if the green line is going up and the blue line is going down, you have new hedge funds shorting and new longs buying. You have a buyer and seller quickly finding each other at equal rates. This is actually called a liquid market. And then when asset managers are selling, right, week after week after week, the net long is less. It means most of them are selling and shorts are covering. This is also liquid. When buyers and sellers find each other at equal rates, markets are liquid. And you can find any single point on this market where the green and blue pinch towards each other or pull away from each other at equal rates. In these periods of time, you will never see a liquid market crashing. It's such a cool phenomenon. Here's a point where they're pulling away, nice clean bull run. Here's a point where they're pulling away, nice clean bull run. Liquid markets do not crash. So if you're now in a long only strategy, according to the monkey, forget the illiquid markets because they tend to crash. Liquid markets don't crash. So now we just upped your win rate even more. Not only is position sizing important, but understanding that if you trade in a liquid market in the quote unquote long only strategy, you're likely to have more of those green days and green months than ever. Do we all understand this? So far, so good. Liquid markets do not crash. Again, the price protection of competition keeps the supply from going to inflating to infinity, and the demand protection from the available buyers prevents a collapse in the market. You guys got that? We all understand? Liquid markets don't crash. So if you're doing the long only thing, let's find liquidity. Let's find where buyers and sellers are there. So anytime the green and blue lines pinch and pull together, the markets don't crash. But anytime, as a matter of fact, just let's pick the point where the blue line, actually let's start here. The green line is selling and the blue line is selling right about here. They're both pointing down. When everybody's selling or everybody's buying is known as an illiquid market or volatile market. As a matter of fact, volatility is an inversely proportional liquidity. The reason volatility exists is because there's a lack of buyers and sellers, a lack of supply or a lack of demand relative to the other. So illiquid markets, i.e. volatile markets, just put the word ill here, illiquid markets crash like crazy. They either crash this way or they crash up. We call them melt-ups. Short squeezes can be crazy illiquid markets. Now, where I drew where they're both sloping down, you can easily see this is December, January 2021 or 2022, all the way to August. And ladies and gentlemen, there was your recession that year. Illiquid market, right? So illiquid markets tend to be those bearish months, which are roughly 30% of months. So illiquid months, you got that, okay, red month, and then 50% of the candle, the days are going to be red. And then, 60% of those 30% of months, which is 18% of months, are still going to close with a really solid green week, like rallying at the end of the month, right? So now we can see like what kind of market we're in, illiquid. So one thing is that liquid markets don't crash. And you can do this exercise very easily to understand the state of the market that you're in. Let me tell you something really cool. What kind of market are we in now? Well, green is going up. And if you really zoom in on this, since from like way back here, blue is like, what is this? Minus 430, and now we're at 324. Green is going up, and blue is going up as well, right? Ever since roughly here, we're actually in an illiquid market. It's crazy, and the market is very sensitive to news, very sensitive to catalysts because we're illiquid. You guys remember FOMC way back in here? The market would like do nothing. But FOMC over here, the market crashed for a day. Welcome to what happens when markets are illiquid. They're very sensitive to news. It doesn't take a lot to create a price crash in the market, right? We're in an illiquid market to the upside. It's fueled by short squeezing. Shorts are squeezing and longs are accumulating over the bigger haul. And why is that? Because everybody was betting on market topping, and all of a sudden the AI tech boom is starting to squeeze out a bunch of the shorts. People that were rapidly shorting the market here are now getting squeezed out the last year. And how can you recognize a short squeeze is very simple, is by a little bit of curvature in price. So see if I can find an easy way to see it. From here until here, the blue line is going up, the green line is going up. Here's a previous example of an illiquid market when they're both going up. Here to here. A little bit of curvature. Short squeezes that are fueling long markets at the same time tend to curve faster. They exponentially go up. And if you guys remember the earlier S&P chart over like the hundreds of years, the S&P kind of has that curvature shape as well. That same exponential growth is something that you see in short squeezes as well. It's compounding. Shorts cover, which makes more shorts coverage, makes more shorts cover. Nice, strong liquid markets that move up tend to move up in a straight line. But illiquid markets tend to curve and speed up as they move. And you don't see much. You see like not a lot of curvature here. You see right here, it's kind of starting to speed up. So in the longer haul from here to here, the market is actually not really doing much to prove that it's ready to crash. As a matter of fact, shorts are covering at a monumental pace. And when do markets sell off? And again, this is a week-old data point that's published once a week. You need the blue to go down, as we showed before, and the green to be going down for us to be considering the market selling off. Now, on the shorter term scale, it kind of looks like that's maybe happening over the last month. So right here, the market is kind of in that mode, right? Short squeeze, curve in, but now we're kind of, okay. So week after week, come back and revisit this to see what kind of market we're in. So number one, liquid markets don't crash. Number two, last fact. And this is something I'm going to take to the grave as well. Market makers. There's two rules of thumb with liquidity. This red line, it's gone above zero. Typically the dealers are positive or negative because on the non-dealer side, dealers are liquidity providers. On the non-dealer side, there's usually more people betting for the market going up for obvious reasons because a lot of people are slightly smarter than blind monkey than people being contrarian to the market. And most of the most of the contrarian bet here is actually just hedging. But the key takeaway, ignoring the yellow, which is like federal funds, Fed banks and things like that, the yellow is relatively close to zero and not super important. But if you take the green, 984,000, let me move this over. The green being so large and the blue being so small to the negative side, there's always an imbalance of long versus short. There's always so many more people longing than shorting. So the dealers have to be the other side of that selling, negative 800, whatever, thousand, right? So very few instances in time you'll see the dealers go positive. Okay. But when they do, I'll tell you this. When the dealers go positive, the market has never crashed once in that scenario. There are times when the dealers go positive where crashes stop. And this is going to help the blind monkey even further. So if you can detect the markets crashing, which I tell you I'm going to teach you in this class, a bunch of avoidance indicators to avoid a crash. And number two, you can use things like the community traders to find out when that perfect week or month is so that the market's no longer dying out. It's a very interesting thought. Market makers aren't going to crash the market under their own feet if they're holding the supply. They have infinite money and infinite power and infinite patience to hold out. But you will see, and again, I've made some really, really stellar calls in the market of market reversals using this chart alone. Very, very, very cool thing to take with you is that as markets are selling off, when everybody thought the market was going to crash in 2022, right where my mouse is right here. Let me zoom in a little bit bigger. At exactly this moment in time, the market makers went positive. And look at that. The market stopped selling. And then it went negative again. And then this very moment in time, the market went positive and it stopped selling. The minute this red line is above zero, crash is over. Add that to the monkey's strategy. The monkey just got slightly better. We can avoid illiquid markets. Let's just sit out those months and let's just wait till the bull market comes back. It's liquid. We're good. Dealers are positive. Okay, so liquid markets don't crash. And when the dealers themselves are positive in S&P futures, the market has never crashed once in the history of this report, which is over 20 years old. Pretty cool, right? So a monkey that's trading on longer time frames is going to want to wait and avoid illiquid, volatile markets and wait for liquidity and wait for dealers to be positive. If you hold the inventory, remember, he who holds the inventory sets the price. So if the dealers are positive, then everybody's selling to them. And now they have all the shares of stock. Do you think they're going to crash the market under their own feet? No. Markets don't sell off until the dealers themselves are negative. You guys remember The Big Short movie told you the same thing. Housing market didn't crash until all the banks that were out there selling credit default swaps themselves had a net majority of them. And then they stopped bribing the ratings agencies to rate mortgage bonds great when they weren't. So they amassed their own short position before they let the market crash. That's how Wall Street works, guys. So when your market makers or your dealers are positive, the market will stop crashing. Let me show you something cool on Twitter. I tweet my big calls, and I use this to pivot the market. So when you can say markets are illiquid and the dealers aren't positive and the market's selling, what's wrong with waiting till the next month to see if things got better, or waiting a couple months? Remember, the blind monkey is only going to zap their account pretty hard if they get into 3 or 4 bad months. Lucky for you, you can sniff them out a mile away. I'm going to show you a couple more tricks to do that. Way back in the day, I do this, and I like to show off when I do this, but I tweet this, and then I show, let me get my little tweet here, my big calls just using this report. Okay. All I did was use the commitment of traders and Rocket Scooter's monthly maps. But if you guys remember, as every bear in town was like, markets are selling off, I was on a bunch of really big name podcasts back in the day because I was still perma-bull down in here. Not perma-bull, but bullish down in here, sorry. And people were like, Matt's pretty much always long in the market. Well, we always know why, right? Strategically, I just avoid crash markets and I long bull markets. I don't go out there and try to long, short, long, short, long, short. I don't want to play the game that when I'm shorting 50% of the time, I'm gonna pick the direction wrong. Already proved that. So I'm either long and strong and long or waiting out, right? And I'm still longing through here. As a matter of fact, down here on this particular day, I said, here's to a 2-month bear market rally. Now, I used Rocket Scooter's monthly map to see the position of shift, but I also used the commitment of traders to say right here, the market's going to rally for 2 months. And right here, I said I'm calling a bottom for the year. And on the podcast I was on with every bear in town, all these fundamental people were making fun of me and trying to make me sound stupid. You just don't understand that stocks are trading so many times over earnings. Inflation is running rampant. This market's going to collapse. And I'm like, I don't know. Liquidity providers, the dealers are positive. They'll crash the market on their own feet. You don't know anything about trading. I'm like, I don't know. I win trading contests. Maybe I do. And people were just like heckling me so hard because I said, guys, this is the bottom. They're like, no, this market's collapsing. This is the bottom. As a matter of fact, last week I said, here's to a 2-month bear market rally. And we rallied exactly 2 months. And here I said, this is the bottom for 2022 on October 17th. On this day, nothing here tricked me, but on this day. And then here I said the recession is over. And here I made another thing that said, actually, we're rallying until October. What was special about those 2 market calls? And here it is. I mean, it's right here. Here's the 2-month bear market rally right here. Positive. Right? October 17th. Here's the bottom. What's so special about that? Positive. Is that cool? So understand something. There are things, and I just want you guys to understand, there are things you don't know about the market that are really good tools to have. And this is one of them. This is actually one of them. As a matter of fact, way back here in March, right here, markets were rallying and continue to go higher. Pretty neat, right? And that's what we're here for. And you can see that, back here, here's March, April, May. Right here, markets rallying. And I'm comfortable saying at 4,000, the recession is over. We're going to continue to rally. And even 4 years ago, 2021, I made a call, and I'm going to show you guys this in a little bit. That said we're going to S&P 6,000 when it was 3,000. And we're now 4 years later, and we're now at 6,000. There are some really key aspects of just larger term tools that you can use to find liquidity. Remember, our goal is to find where buyers and sellers can be. Now, let me show you some day trading techniques. So far, so good. Are you guys liking this? Are y'all enjoying the content so far? Okay, good. We'll move on. All right. So ways to avoid markets and day trading tricks and position sizing tricks. There are a couple of neat things that we do here at Rocket Scooter. So liquidity map is a way that we use, and we use options to find high volume pivots. So when you can find when there's markets are liquid and you can find when markets are strong and bull, that's really what I look for. And I don't always try to short markets. As a matter of fact, there's only 3 really strong times I short and like 7 or 8 times I long. So there's a lot more of my setups are long than short because that helps benefit the blind monkey. And Rocket Scooter, the platform, if you guys are interested in the platform and getting all these are all liquidity finding tools and finding out when dealers are negative and things like that, this actually tells you that on futures or indices or stocks or anything. There are 3 things that we use to decide if the market's bullish, called the greater market. Okay, the greater market, there are 3 tools. And again, markets are closed, so there's not going to be any data here. But there's a ratio here that's between 0 and 100. If that ratio is greater than half, it means the stocks themselves are bullish, okay? Another thing is if SPY, so when I'm trading S&P futures, I'm going to look at SPY. This is a calculation in the equities itself. If SPY is greater than this orange line right here called MHP, then on the month scale, SPY is bullish just through hedging. So if you're trading futures, it's very important if you're trading ES or NASDAQ to understand that those are tracking the index, which are tracking the stocks. They very much care about what the stock market's doing. So let's look at the stocks, which is here. Let's look at an index ETF monthly scale hedging. And let's look 3 months out to kind of see where the liquidity is there as well. We have something called monthly maps. And monthly maps also help me do those predictions on Twitter that help me see how the positions change over time. So this is all liquidity finding trick. If the stocks are bullish and there's an adequate number of buyers, stock markets don't crash if this number is greater than half. It's just like the other chart. Very rarely do they do. Market's just liquid when there's people buying stocks in a bull zones. SPY greater than MHP, there's just this natural wind of long hedging in the institutions. Typically, that happens in modes where on that committed traders, that green line was going up. You're going to see that both of these things are bullish most of the time. And this will help you see 3 months into the future, which is showing you the positional landscape and options. We use options to forecast where volume is going to be, which is very important because volume is required for liquidity. And as we said, liquid markets do not crash. So these are like liquidity finding tools that, as a matter of fact, I'm bullish if just one of those 3 things are bullish. Then take all 3. If just one of those things are bullish, I'm a bull. If all 3 of those 3 things are bearish, then I'm finally a bear. And why is that? Well, because the market goes up 70% of months and goes up 50 to 60% of days. It takes a lot to convince me to be a bear in those 3 out of 10 months when markets are bearish. As a matter of fact, this was the first time in 2 years that I finally said I'm bearish. In 2 years. I even tweeted about that. You guys remember my big tweet on December the 9th. On December the 9th, I said I'm finally a bear. And this is why. Let me see if I can find it. Let me put it here. So on December the 9th, I said from October 17th, 2022, I was bullish until here. And finally, after the Fed thing came out, I said, I'm finally a bear. I'm only bear when all 3 of my signals are bearish. And it could be for a day, a month, or a year. I take bearish just one day at a time because there's only 30% of months are bearish. So today is day 1 of being a bear. And what's the neatest part about that is on the way up, I'm not the one saying the sky is falling, sky is falling, sky is falling. I'm like, ride the trend, ride the trend, ride the trend. And I want you guys to tell me, do you think I did pretty good? Finally, right here, saying that I'm a bear. Did I do a good job? I hadn't said it once in 2 years. Did I do a good job? Did I nail it? I was a bull from October 17th all the way to here. How'd I do? Because the market certainly does feel bearish now, doesn't it? These days are really hard to trade and choppy, and market's now trending down. Did I do a good job? I nailed it, right? And so the 2 tools that I used to do that are very easy. It's these three different indicators. When all three of them are bearish, and after this day, the very next day, all three of them are bearish, I'm finally a bear. I'm taking bearish just one day at a time. It doesn't mean I'm out there shorting the market like crazy. I'm still longing these waves up, but I'm longing cautiously and taking smaller trades with smaller positions. Again, the blind monkey benefits from you taking smaller positions and adjusting your position size when you know it's a bear market. As a matter of fact, on my stream yesterday, I was trading micros in a bear market. I'm helping my loss rate even more by trading smaller when I know markets are bearish, right? And so this is just kind of like a summary of what our courses are like. Our courses are so detailed and a lot of these different techniques, but this is very important. Remember, yesterday I was trading micros. That's because I would take less risk in a bear market. Am I still bearish? I'm no longer bearish. As of now, I think 2 days ago, I said I'm no longer bearish. 2 of the 3 indicators are now bullish. So I'm no longer bearish minded. I'm bullish minded. I'm back to trading slightly bigger. So it takes all 3 of them to be bearish. And I'm always looking for any excuse to be a bull, whether the stocks are rallying, the ETFs hedging, or even the monthly maps are good. So what are monthly maps? Are ways to sniff out liquidity as well. So any stock, it doesn't matter what you do, any ETF, you trade NASDAQ futures, pop QQQ on here, click this monthly map button. And I don't know if it's going to show it because the markets are closed. I wish it did because we'd have a good example. Yeah, we don't. It'll come tomorrow on the stream and I'll show you. But what monthly maps is, it plots out where the bull and bear side of the market is over time, and you can just see, are we bullish or bearish over time, and is the market liquid? This is a very much a predictor of that commitment of traders. I can see 3 months in the future with this because options tell me the risk and the landscape of how it changes. So I can actually forecast this 3 months in advance and say, we're liquid for the next 3 months, which is what I did to make those big calls. Unfortunately, with the market closed, I can't give you a good example, but monthly maps are ridiculously good. And let me show you, actually, I think I tweeted it a couple days ago. Monthly maps are an invention of myself and people on the team here. Oh, I didn't. Okay, I have one. Open image. And what it is it uses options and SPY to get hints about futures. And so essentially, one of the cool tricks about monthly maps is that whenever you see this dark gray, which is where bull territory is, and this light gray both sloping down, it's the same thing as a liquid. It's the same thing as on the commitment of traders, the longs going longer and the shorts actually covering. So as of a couple days ago, when both of these are sloping down, the bull market's back. And I tweeted the bull market's back. I actually tweeted that. And so while we are selling and trading inside of here, the bull market is definitely back over a longer period of time. As a matter of fact, this shows stability through the end of February. So of those 3 things that I wrote on here, which are my greater market indicators, 2 of the 3 are bullish. The stocks became a little bearish, but this is a market cap weighted thing. And NVIDIA has been selling in the news. NVIDIA has been what's been pulling the market down the last 3 or 4 days. The majority of stocks, however, have been green on the number of stocks total. So while market cap weighing is part of the reason why NVIDIA is allowing the market to move so quick, not every stock is selling. So anyways, right here is when I said bull market is back. So I fully anticipate this market to do this next week, next month. I don't see any evidence of illiquid market. A little bit of selling, a little bit of buying. This is not drastically pivoting the other way. Just a little bit. The maps look good. So here I was bearish, and for good reason. And then here I'm back to being bullish. So what I can do is avoid a lot of this bear noise and even miss out on some of those green months and green weeks to even improve my success rate higher. And people ask at the beginning of this, like, Matt, how do you get 70, 80% win rate? Because I avoid the market a lot of the times. And even if I know the market's bearish, you may ask, well, why aren't you shorting it? Well, what percent of candles on the daily basis are green? Everyone, quickly, in all environments? Type it. It's one of the things I want you to type. So you remember this. What percent of candles are green on the daily? While there are short and long setups in any direction of the market, if I'm trying to just weigh my odds somewhat into my favor, isn't it better? It's 50%. Days. 50% of days or greater are green in all markets. So every other day that I try to short, the market's going to squeeze against me. So I'm not always trying to short markets. Like I said, I have very few short setups. Liquidity map will show you what some of them are. If I click on this, there are certain things that are really good at shorting, like shorting off of this orange and shorting off of the top of this light gray. But for the majority of my trades, I'm going to be taking long setups. Okay. All right. So far, so good. And it's been very well. As a matter of fact, once I stopped trying to short markets and either just sit out of a sell-off, which is what you see me do, and just find a dip to buy in random spots, not random spots, calculated spots, my win rate went from like 50% to 80% when I stopped shorting markets. I'm not saying this will happen to you. What I'm saying is, if somebody were to put a gun to your head and tell you to pick, the first thing I asked you in this exercise was which way would you go? And you said you would long the market. And why don't you do that? What tells you not to do that? It's weird that that's your first inclination, yet you don't do it, right? So the idea is to do something for myself that's better. Let me see if I can get a liquidity. I don't know if they're going to print today because the market's closed. Yeah, I don't think we're going to get one. Can do something. Let's have a picture of one. But the thing I do is that if I can detect that the market's illiquid or crashing, I get out of the way. We have 3 really good avoidance indicators that are super awesome. And I'll show you one of them. They automatically populate on the chart. If you use the Rocket Scooter platform, you have a futures data feed connected. We give you these bands. And what these bands are based, they're an exploit of the margin requirements of the CME. We calculated something as predictable high volume pivot. As a matter of fact, we have 15 different ways to predict volume. As you remember, volume is required for liquidity. So if you're looking to find liquidity and where buyers are going to be, this is what Rocket Scooter is designed to do. There's nothing in here that's price-based technical indicators. Everything here, 15 different tools that we invented at this place are to predict volume, are to find liquidity or lack thereof. There's 2 indicators that we teach that are no trade whatsoever. I mean no trade whatsoever. If either of these 2 things happen, I avoid the market like the plague. I close down my platform and go away. When the Fed crashed, both of these things triggered. During COVID, these things triggered multiple times. As a matter of fact, the index catalyst happened the last 2 days in a row. There's a catalyst that was active. No trade whatsoever. So imagine the last 2 days of market trading and imagine how fun it was for me to just avoid that noise. Let me show you NASDAQ futures and environment. Catalyst is triggered. This pink line is when a catalyst is triggered. We teach you a method on how to detect when that catalyst is active. Below this pink line, a catalyst is active as well. I avoid the market. Right here, as soon as we break, I'm screaming in Discord, there's a cat active. And again, this is one of the 15 techniques we teach you in our courses. And by the way, our courses are free if you're using the platform. If you're a platform subscriber, the courses are free for you. There's no additional cost. It's a benefit to our platform subscribers. If you're not using our platform or you're not using our tools and you just want to come to the classes, they're actually just $20 for the month. So it's $1 a class. Sessions are just like this one. This is covering a whole variety of topics, but each one dives into a specific topic, especially we had just one on this the other day. And so when the NASDAQ fell below here, I just avoid the market. And imagine what your life would have been like had you shorted here and got squeezed out 100 points, or had you long there, got squeezed out 250 points. This volatility is unimaginably difficult to trade. There's some cool rules of thumb I'm going to teach you. They go with that, right? As everyone can see on the chart, there's like a really solid difference between, above this pink line, market's trucking along, it's nice and stable. And then below this pink line, can we all agree that the market seems unusually volatile? If I describe volatility as how much the market V's up and down as it's moving, can everybody see that the volatility here is ridiculous? It's small, then it's big. Big V's, small V's, big V's. You see how the market just seems out of control, and here it's just like mild, medium, 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 small, small, small. Does everyone see a night and day difference between here and here? Yes? 250 people here. Do we all see it? Remember when I said volatility is the inverse of liquidity? So if the market is volatile, it's not liquid. And markets that are not liquid are dangerous to trade. As a matter of fact, if you can identify unusual volatility, avoid the market. As a matter of fact, I enjoy taking the day off. I just go hang out with my dog, or I go do whatever. Right here at 21,630, I'm screaming, I'm out, I'm done for the day. And the market fell 400 points. Now you may say, well, we could have shorted that, right? No. Yeah, you could have, but guess what happened? You would have shorted the wrong spot. See, here's the difference between illiquid and liquid markets. So, do we all agree that markets that go up aren't volatile? Do we experience that, right? We know when markets go up, VIX goes down, but you didn't know that when markets go up, these V's don't get bigger. They roughly say the same. As a matter of fact, they sometimes get smaller. We all agree? When you long a market randomly and markets are going up, the dips are less dippy because there's no volatility. They're liquid. And remember, liquid markets don't what? Fill in the blank. Everyone, liquid markets don't what? Right? They don't crash. Because there's no volatility. There's buyers and sellers nearby. So a bull market, if you long at the top like an idiot, like you're a blind monkey and you chose to throw the dart right here, you're not really punished much by chasing the top relative to chasing the bottom. When do you enter your short? Which of these green candles is it? Well, it might not look like a lot, but between here and here was 80 points on the NASDAQ. Jesus Christ, that's crazy. Which one of these green candles was it until you were right? What happens if you shorted at the bottom while the V's are getting bigger? You're upside down 200 points. And then 3 hours later, you finally go green for a couple of minutes, and then you're upside down hundreds of points again. And then another 3 hours passes by, and then you finally make money for like literally 1/2 of an hour before you lose it all again and turn out flat. This is why shorting markets, especially crash markets, or trying to trade them at all, is a fool's errand, because you can't time the best place. Now, you should short on a green candle in a bear market, but which one of these green candles is it? The V's are unusually large, and it's hard to time your entry. So a short market, do we all agree, punishes you more for your bad entry than a long market, because the volatility is going up. If you long at the top, your drawdown's really small. If you short at the bottom, well, you just busted all 20 of your Apex accounts, did you? Do we all see that? So now that you know this, what would you do if you could predict that volatility was going to go out of control? Now you have a choice. You are a blind monkey, and I allow you to pull one part of that blindfold off now. You already figured out how to make money randomly longing the market, but now let's improve your odds by teaching you when to sit out of a bad one. If you can predict that volatility will be present, it's a lack of liquidity. Remember when I showed you liquid markets don't crash? Your brain should say, I want liquidity more than anything. We teach you how to calculate this pink line. It's one of our classes. I'm not going to teach you today, but in the classes, you'll learn how to do this. If you hear me ever say the word catalyst in my stream, I'm sitting out. Because at a certain distance, there's a way you calculate this on an event that below here, there is guaranteed, I say guaranteed, volatility increase. Therefore, there's a lack of liquidity. So illiquid markets can crash. Now, if you have the choice, because remember, randomly longing the market and controlling your position size makes money. Well, choosing to sit out is the eye opener is controlling your position size. It's actually engaging in a trade, except you're trading zero. You actually chose to trade zero. So you're the monkey that chooses how big or small you trade. Today, I choose to trade zero. I'm sitting out. So if you choose to sit out when we say a catalyst is active, you're going to avoid volatility. Again, we can't give you investment advice or trading advice, but now that you know this, do you want to trade? Pretend that you have this back pocket indicator with you every day. Do you want to trade this? Are you looking for a dip to buy that somehow liquidity magically returns to the market and you got a nice bull up? Or do you think, you know what? I'm going to choose to trade zero because I don't want to engage in longs or shorts when markets are volatile, when I'm punished for my bad entry. I'm going to experience lots of drawdowns. As a matter of fact, in trader funding programs, most every one of my trades is a long trade. That's how, I'm funded. I'm funded with Apex. I'm funded with ETF. I'm funded. I make money with these. I said a payout from ETF, $15,000 last week. 90% of my trades are long trades, and I sit out the rest of the time. So everyone here, knowing what you know, at least in this class, if I tell you, you can guarantee that it's not a liquid market in here, can you see the danger, the immediate shape shifting on this side of the market versus this? Do we all see it? I'll make sure everybody's on the same page before we move on. Finding liquidity is very important, right? Extremely important. All right. Okay. So in the Fed, we triggered a catalyst. Let's go all the way back to Fed. All right. Now let's look at the Fed. Imagine this calculation at 20. Like again, like I said, tell me that who here has just tell me, be honest, who here doesn't have an indicator that says sit out? Here's an indicator that says sit the fuck out. You're a moron. Anybody have an indicator that tells you to sit out? Volatility is the biggest nonsense sold by traders. You know, my ETF payment of $15,000 after like 2-3 weeks of trading, I made that scraping out 15, 20 point moves in the S&P. I don't need 100 points to put money in my pocket. I make my house payment, my car payment, my life payment. I live the life you guys all want to live as a trader by making 10, 20, 30 point runs in the S&P. Hundreds of points of volatility, I sit out. The gurus are teaching you that volatility is the way to go, but volatility is the way to sit out. I got an 80% win rate by avoiding the market when it's volatile. That's it. So it doesn't look that bad just yet, okay? But if you go to our Discord, you will see that when the Fed news came out at 22,100, I am screaming at everybody that there is a crash about to happen. And it doesn't look too bad, right? Because other days sold that much, but there's something special that happens here. And in our classes, we teach you that special thing, that the market's going to crash. And I immediately sat out. As a matter of fact, I was in a micros trade and I got out of the way. And imagine having bought that dip right there because you're an idiot. And the green candle makes you go, oh, it's a dip to buy. And everything below this pink line is don't touch the market under any circumstances, right? And look how nice and calm. And if I remove all my indicators on the chart, right, it looks nice and calm. Nothing crazy here. But this one crash indicator has to do with futures margin calls and market makers. It's an exploit of something called CME Span. It's a program that the CME group uses to set margin requirements. It's based on the allowable risk that futures can take before there's a high probability of margin calls. They take all the reportable positions in futures and they look where everybody's risk is. If the risk is very spread out, i.e. the market has lack of liquidity, they're going to make margin requirements bigger. So as margin requirements get bigger and smaller in the CME group's website, we have an algorithm in Rocket Scooter that gives you the crash indicator right here. It's that column in that table. Okay. And so if the market moves just that distance in that table on an event, like a news event, without one particular thing happening to undo that event, there's a crash about to happen. I'm screaming that there's a crash about to happen. And it doesn't look like it, but the market can capsize on itself. And it still doesn't look like it until that happens. Okay. And I was not in a trade. You can go watch my stream, guys. I was streaming live during all of this. And the market just fell and fell and fell and fell. I used the ability to detect liquidity and the lack thereof to avoid this nonsense. You might have seen some green candles. Okay, maybe that's the dip to buy. And you continue to hemorrhage money. See, I want to ask you guys a question. How many people's trading accounts look like this? Be honest. You grow and grow and grow and grow and you bust it all in a single day, right? You have like 2 or 3 good weeks on your best run and you lose it all in a day or two. Oh, my bad. This part of the chart. I forgot to turn my webcam off here. How many people, that's kind of what you experience. And it's okay if it's you, because that's all of us when we get started. Trust me. The reason for that is you're always trying to guess where the market's going to go. And so when people are in margin, imagine when you were in a margin call, if you ever had one. In a margin call, when you get a phone call from your broker that says, hey, you're in a margin call, or you get the email. Everyone answer this question. When you get a margin call that happens, do you immediately go look at the chart? Or are you trying to scramble to get money or close your position? When somebody says you're in a margin call, are you out there doing further technical analysis? Or are you more like, holy shit, I'm losing money. What do I do? Right? Which one are you? Everyone say, which one would you do? You're closing positions. You're getting out of the way, or you're putting money in your account. You're not out there doing additional research on the market. You are frantically trying to figure out your money situation in a margin call. Did you know that this table that gives you this distance on an event is telling you when the margin call probability passes a certain threshold where the market dominoes on itself, where sellers knock sellers, knock sellers. The idea that something dominoes on itself is called exponential dependency. The same reason that inflation compounds on itself and stock markets look like this, well, crash markets compound on themselves this way. It's people that don't want to sell that are forced to sell. And the curvature alone indicates that the market is a catalyst. We call it a catalyst because as a chemical engineer, which is my background, catalyst is something that speeds up a reaction. It's like I always say, a bunch of people standing on a bridge, and the first person in the front gets wobbly and starts to fall. Then they grab the person behind them and yanks them down. And then they grab a person who grabs a person that grabs another person, and everybody's pulling each other down when nobody was falling to begin with. And so that cascading effect of 1 pulls 2 pulls 4 is called, it's exponential dependence. It's compounding. And so crashes compound and speed up as they go. You can see that it's curving, it's accelerating. The liquidity is rapidly decelerating, the volatility is rapidly accelerating as well. The market is falling apart and nobody's out there doing any kind of analysis. Everyone here is in the same boat as you. Oh shit, I need money, or oh shit, I need to liquidate. The V's are getting big, they're getting bigger. Hundreds of points of V's. This is 50 points, 100 points. This was 300 points of V's. This was 400 points of V's. All right, now let me tell you again. Does this market scare you? Let's start there. That the volatility gets exponentially larger. Does this scare you now? Wouldn't you like to trade when that's not a thing? Like the dips are nice and stable and nice and clean and nice and easy, terrified. So to have crash indicators, whether they're ours or anyone else's, the probability of margin calls go through the roof. And it's not people looking at charts saying, well, we're going to buy the dip. There's tons of people behaving weirdly and irrational down here, which is why we teach one rule is that when there's a crash that's active, in our Discord, we give you this thing, and we say, when an index catalyst is active, there's no trade whatsoever. Spontaneous, unplanned, or planned news reporter event index moves this distance from the anchors from the table. No trade whatsoever. Why bother? Like I said, I only need the S&P to move 10 points for me to make 10 grand in a trading day. I don't need to trade every move of the market. We always say that a hungry wolf that's starving in the forest that tries to chase every very quick squirrel that's moving around is going to wear themselves out and be too tired to even approach and chase down a boar with a broken foot. So don't exhaust yourself trying to play every single move of the market, especially this. Imagine the headache you had, or how much you felt like you're going to throw up. You're in a long trade, and then 3 or 4 minutes it feels good, and then it feels bad, and then it feels good. The roller coaster you experienced blowing up your account. The reason you don't ever, and you have never seen me in almost 10 years of streaming, blow up an account live on stream is because I avoid the market. Remember, the key pillars of what makes you a profitable trader is have avoidance indicators. If your strategy has no avoidance indicators, you're susceptible to the blind monkey of actually being in trades times like this, because he's just randomly longing and you're randomly trading as well. But an avoidance day makes my win rate go up even further because I don't have to play when the market's falling apart. When people are falling off the bridge, there's no liquidity there. Why would I trade if there's no liquidity? Why would I buy that house at 400K and try to flip it at $1 million for that example if I can't prove there's any buyers? Can you prove that there's any buyers here faster than people are falling off the bridge? No, you can't, because you don't know their risk. You don't know their leverage. You don't know their exposure. You don't know if whatever fund is getting squeezed is out of money or can go to Citadel and get them to give them $2 billion or $10 billion, or just has to come up with the money themselves, or has to liquidate their crypto assets to fund. You don't know what people are capable of in an area of panic. So we have this is panic in the market indicator, right? So the idea is anytime you see me draw a pink line live on the stream, a catalyst is active, and I avoid the market that day. And it only lasts that particular session. One of our rules, on this day, I avoided the market here. Would you believe that this indicator alone upped my win rate 10%. Personally, me. I can't guarantee anything to anyone else. I will tell you the stats of traders. Majority of traders are going to fail, and the majority of you will fail. So don't let this be a sales pitch to tell you, buy my shit, you're going to make money. You're also probably going to fail. But my win rate, I'll tell you about mine, went up about 10% with this one indicator. That's it. Okay. So far, so good. I can detect when there will be rapid onset volatility just by one indicator. Do I want to trade when the market's shuffling up and down hundreds of points? Absolutely not. How about yesterday? A catalyst was also active yesterday. Who here blew up a trading account? The stock market went absolutely nowhere. Let me ask you that. Okay. There's a certain distance that futures can move on a rapid onset buying or selling spree that overwhelms the ability for the market to provide liquidity. This is a highly illiquid market right now. Okay. I made one trade and it was micros and I lost like a meager $1,200, right? My trades are like 5 figures per day. $1,200 is my smallest trade ever because I took a gamble on micros and that one trade was a loser. I also made another trade at the start of the day, but my candles weren't updating and I bought at the wrong spot. So I took 2 small losses and that's it. Small losses. Because once a catalyst is triggered, my brain immediately goes into no trade down here. And then up here, I'm going to trade small, if anything at all. So imagine playing the chop. I'm up or down fraction of what I normally would be. So that is one of the things that can help the blind monkey as well, which is to throttle your position size based on your confidence. Of the 15 indicators we have that predict either volatility or illiquidity or volume, have I proven to you that I can predict when the market's going to fall apart with just one indicator, that the volatility is going to be nuts? Are you guys convinced so far that this is a volatility predictor? Margin call predictor. Get out of the way. So why would I go out there and think I know better than Wall Street, who's out there in a mix of pandemonium trying to shuffle, get funds together, right? So why don't I just avoid the market and let them figure it out and come back the next day? And that's the goal. So one of the 15 indicators is an avoidance indicator that's allowed me to avoid this day at that moment, this day at that moment, and of all the different crash days we had, I was in no trade right here and no trade right here. So as a blind monkey randomly longing the market, I'm not randomly longing the market there. I'm on the sidelines with my money in my pocket to come right here when things are better to get back to trading. So with that, I now made my odds slightly even better. Now, the rule of having a good strategy in general is to start wide like we did. Create a scenario where I said blindly longing the market. This is how it can win if you throttle your position size. And then I said we're going to build on top of it. So now I have avoidance indicators. One of the 15 indicators we teach allows me to avoid the market that particular day. So now of the stats of red day, green day of markets, having 50% of days are red, imagine of those days that I avoided that day, and I avoided that, and I, for the most part, avoided this. So not only am I avoiding blowing up my account in a single trading session when markets crash, I'm not caught bag holding. This is our anti-bag hold indicator. This is the sit out and let Wall Street figure it out kind of indicator. So all the indicators, and that indicator predicts lack of liquidity, which is different than our other indicators that predict liquidity. So instead of using it as an actual indicator to long the market or short the market, it's an indicator that tells me volatility is running rampant and get out of the way. We have another one that does the same thing. When the VIX moves a certain distance from this table, it's another thing, get out of the way. We have another indicator that's really good. It's a rule of thumb. And I tweeted about it and went slightly viral. It's that when the VVIX is greater than 100, or the VVIX breaks into 100 and goes higher, you can prove that the VIX is going to go higher as well. Now, what's the VIX? VIX is a measure of volatility, i.e. the measure of lack of liquidity. And so you have 2 back pocket indicators in those 15 that also allow me to know the state of the market. There's one level we draw every month that's based on VIX futures called triple B. As a matter of fact, when you were above this is the one from this month. I keep all the history on here for educational purposes. But if VIX is trading above here, there's one simple rule that you can take from that. The markets are extremely sensitive to news. For that entire month, we've been above here. Have you guys noticed that this month the FOMC crashed the market, and then a couple of days ago, the services PMI, the prices crashed the market? And Jolts actually came out very bullish, and the prices came out, the next report came out as a blip, and it looked pretty bad. Markets collapsed because this indicator tells me the market's sensitive to news, very sensitive to anything. This is underpricing volatility, and this one indicator, it's once a month level. And above here, I know markets can be very sensitive to news. So now I made my blind monkey strategy even better. I'm avoiding trading news, especially in environments like this. So even before the catalyst indicator tells me to sit out, I'm already wanting to sit out because the market's going to be overly sensitive to news. Remember the FOMC reports, the last 4 or 5 that we've had? Did the market crash? Absolutely not. Like, did it crash like this? No, absolutely not. The market might have sold off a little bit or had some kind of like an excursion day, but the markets have not collapsed on FOMC news for the most part because the VIX itself has been safely tucked below that line. So that is an avoidance indicator. It tells me this is not the month to trade on news, right? Before August, you had July, June, all of these days, they were actually below their respective lines. Volatility itself was in play. It was good. Markets were liquid. And guys, when volatility is in decay and below that level, the market is liquid. And as we said, liquid markets do not what? They do not crash. So I'd like to trade environments that aren't crashing because crashing is pandemonium. And another back pocket indicator you can take with you is the VVIX. Anytime the VVIX is above 100, the market is going to be choppy beyond all get all. You yourself, if you're trading and your normal lot size is 5 minis, I'm just going to say something. When the VVIX is above 100, you will trade 1/5 of that or lower. Okay? Because this indicator being above 100 is guaranteed. VVIX is the volatility of the VIX, which is the second derivative of the volatility of the S&P. So it's like the volatility of the S&P while the V's are getting bigger. When VVIX is going up, the V's are getting exponentially bigger, just like that NASDAQ that we showed you that had bounces of 20 points, 30 points, 100 points, 300 points. It's certainly curving. And VVIX above 100 is a curvature detector that's telling you volatility is the V's are curving. They're getting wider even faster. There's accelerating. So anytime VVIX is above 100, just as a rule of thumb, trade like 1/5 to 1/10 of what you normally do. Does that make sense? So rule of thumb, VVIX above 100, trade very small in these environments. You'll thank me later. Trade with micros, because even if you're right on the trade, imagine this. A mini that goes 10 points on the S&P is $500, right? A micro that goes 100 points is also $500. With that, you can be up or down $500 on this day and up or down $500 on this day just by changing your position size. If the danger is there and the confidence is there that the market's falling apart, if you choose not to sit out, choose to trade small to the magnitude of 1/5 or 1/10 of your normal position size. The market's going to move 10 times as far, or the V's are going to be 10 times as crazier, trade 1/10 of your position. So you survive that. Remember, the blind monkey makes money not because of anything other than surviving. And that's what you're deciding to do as a day trader. Why do I blow up on stream? Because I'm a fucking cockroach. I'm a survivor in a nuclear winter. I am surviving. I am the one thing that, I'm not really a cockroach, but I'm like a cockroach. I'm the one crawling out under the debris when everything else around me is dead. And I'm still alive, and I still got food. Okay? As funny as it says, we tell people be a roach. Survive. At all costs, survive. You make money by surviving. The blind monkey made money by surviving. Changing your position size when you know the market's going to go really rapidly or very volatile is the key component. If you are trading trader funding programs and you want to know the secret to getting funded as a trader funding program, or a secret to avoid the market, if you just keep buying accounts and blowing up and buying accounts, you've been trading for years, you've never been funded. I got funded within I got funded within 5 weeks of trading with League Trader Funding. Within 5 weeks, funded. I went just sim to funded, and immediately rolled my payouts into a live account. Immediately funded. They're like, no, we want you to trade real money. Consistency goes through the roof when you have a good avoidance strategy. You just can't say that. And we have a bunch of indicators, but if you're out there and somebody's teaching you charts or teaching you anything market, and they're not teaching you, these are some strategies to avoid the market, you are buying magic beans, buddy, and you are definitely going to ruin your trading account. So any good trading strategy tells you, I apply my strategy between here and here conditions, either this condition or that condition. And beyond those conditions, I know that my strategy doesn't work and I don't apply them. We have boundaries on all of our tools here. Each one of them has conditions that go with them and when they work better. Here's a condition for you to not blow up your trader funding programs. You want the highest probability of becoming a funded trader or to get funded with Apex or get funded with ETF or get funded with Top Step. Here's what you do. You wait for our 3 greater market indicators to be bullish. 1, 2, 3. If all 3 of those things are bullish, the market is so liquid, it's just gonna hang. It's gonna hang and be cool. Market is liquid on all time frames. The stocks today, S&P for the month, and S&P for 3 months. If all of that shows liquidity, as Rocket Scooter's indicators are really good at doing that. And then number 4, this VIX is below the sensitivity level right here. BBB. If all 4 of those things line up and you're good. And then number 5, VVIX is less than 100. I'm going to tell you something. Run and get funded that month. Wait for that month. This is the month you have no volatility, no drawdown. Long's going to be 60%, 70% of the time. Long market's going to move. Market is going to run up straight. Here's a time when that happened. Let's look at May, June, July, when all these rules checked off of this year, right? May, VIX is below that line. June, VIX is below or slightly above that line, but moving lower. July, VIX is below that line again. May, June, and July. Imagine if you just need a baseline. You're like, I need some kind of baseline to slightly improve. Okay. How about, let me make this blank here. Right. Let me review with all the things I shared with you so far. I said I'm finally a bear here after all of this. I've been very cautious in the market. I've been trading micros in the market. Now, as you see, this is much different than anything we've experienced in a long time. Here's what May, June, and July look like when you had the best chance of going out there and getting funded. You ready? Imagine trading May, June, and July. Do you guys see the market collapsing 5% on a single news day? Heck, the worst news day we had, the S&P fell 53.75 to like 52, 100 points on the worst selling day possible. 100 points on 6,000. That's 1.6%. That's not 300 points on 6,000 or 300 points on 6,000. Just 5%. Jesus Christ. Ugh. Imagine just waiting. If you're the blind monkey and now you removed both parts of your blindfold, the greater market indicators plus that VIX indicator allows you to aim all of your efforts at long-only trades in this liquid environment, non-volatile environment, no sensitivity to news. May to June, or May to July, and this is just an example. Let's do May to July. Let me show you something. Let's go back to committed traders. Let's look at May to July of this year. I'm proving something to you guys. All the way back to here. May to July. Green is going up. Blue is going down. That's a liquid market. Liquid markets do not what? Everybody say that. Liquid markets do not what? You do not crash. May to July. I'm sorry, wait, hold on. Yeah, liquid markets don't crash. Or illiquid markets to the upside also don't crash. It's a short squeeze. It's a bull field market. You don't have everybody selling. So the committed traders line up A, greater market indicators line up B. From May to July, everything lined up C. The market's extremely liquid. And again, let me show you what that looks like. Let's go look at the days. From May into July, inside of here. When all those indicators lined up, the blind monkey has both of his blindfolds removed. Let's now count the candles. Green, red, okay? When all those indicators lined up, let's see what the probabilities are now. Ready? From the low, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 21, 2, 3, 4, 5, 6, 7, 8, 9, 31, 2, 3, 4, 5, 6, 36. Ready? How many red days you had? When all four of those indicators line up and the market's not sensitive to the news and the commitment of traders does not show illiquidity to the downside. Ready? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. That's it. 16. You remember when we counted earlier that in a bull market, it was roughly 60-40 on average over long terms on a bull market? Did you know that in a bear market, we counted? Remember, you guys picked 2008. It was 50-50. Right? Green, red. Well, when all of Rocket Scooter's greater market indicators line up, 36-16. Look how much that skews to the bull side. That's not 50-50. Isn't that incredible? So you have overwhelming bullishness when all of that stuff lines up, okay? That's the best odds you do have. We created a series of indicators that tell you when those odds are through the roof, to the bull side. 60 over 40 is 60%. 50 over 55 is roughly 50%, right? So 36 over 16, if you guys do the math. So this is 60%. In bull markets, candles are green. In bear markets, 50-50, roughly 50% are green. When Rocket Scooter's greater market signals line up, that is 69.2%, 69% are green. So the idea is that what makes me so good compared to how I used to be? It's because just like a gambler or a poker player, it's all about the odds. So I created 4 indicators. 2 of them help me avoid the market. 4 of them help me understand when the overwhelming tilt of daily candles is green. My long only, no volatility, liquid markets that don't crash, where 7 out of 10 days are green. Those are the days you go in there and attack the market full force with your long setups and go get funded. That's the whole point of what we made here, is because I'm an engineer, I'm a mathematician at heart, I'm a computer programmer since I was 12. To me, as somebody that would go into a casino and want to know the odds of the game I'm playing, I can play each game differently. These are the days I'm going to be longing hard and hitting the market hard. I just now so the blind monkey removes both pieces of the blindfold and now can say, you know what? I have a hard time trading. You know why you have a hard time trading? Is because these are 3 separate environments. You're trading all 3 of them the same way. Bear markets, you're not trading smaller. Crash markets, you're engaging in volatility. You don't know when the best bull market lines up. We lined up 70% of days that can turn green. We've skewed a normal bull market even better when the market is not sensitive to news. So imagine that I just taught you 2 of our 15 indicators. And this whole thing, I've taught you 2 of the 15 indicators. The rest of them predict volume for day trading, which is really neat. And everything we do is based in stats, okay? Another indicator we have for futures, let's pull NASDAQ up. And one more I'll teach you before I keep going. So, actually, let's just do daily chart here. Okay. So, NASDAQ futures. We have an indicator. Actually, no, I'll just do yes because it's the one that's pre-programmed here. The right number. We have another irrationality margin call predictor. It's really good. Now, remember, I told you a good strategy is going to have position sizing strategy to lower your position or trade really small in certain environments. Another one's going to be how to avoid the market. The other ones are going to be when to line up things that the market looks the best in your favor. Imagine having a lot of stuff together. Now, again, I'm not saying we're the best trading strategy out there, but I'm telling you, of all the days out there, this is the day I'm finally saying it's a bear market. And look at this, expanding market volatility. I'm not calling bear market anywhere else. A couple days crashing, immediately came back up. Well, we've been bearish for like a month now almost. So being able to properly gauge the market and knowing how you should trade is really key. As a matter of fact, I had plenty of 5K days in here, mostly longing. I've actually still mostly longed, even though we're in a bear market. I haven't been shorting. I've been avoiding the sell-off days. I avoided this. I avoided this. And I avoided this. And most days, I'm just buying the dip. So as you see, just on what you're seeing now, you can see why my run rate's going up. Because I'm avoiding nonsense. Okay, so this indicator right here, this is a band also based on that same principle that grounds catalysts into what we call structure points. So catalyst is a structure point where margin calls happen. On a daily basis, without a catalyst, this band is that catalyst distance from the previous day's close. If you count, and this is another indicator, it's one of our strongest indicators we give you, this green band is calculated the previous night and applies all throughout the day. As a matter of fact, when you touch it, something magical happens, this high volume that you can predict. Now, all of the rest of our indicators that aren't avoidance indicators are volume predictors. As a matter of fact, when you touch this green band at any point in time, is guaranteed high volume. It is a fixed distance from the previous day's close. And again, it's an exploit of something the CME does to set margin requirements. Let me just kind of zoom into that day. As you see, even in the overnight, let's go ahead and just kind of scoot the daytime off. This is 5-something-30 in the morning. Okay, here. Way before the market even opens. And as you see, this band that was sitting there all night, do you see that when you punch through it, thousands of contracts? Does everyone see the volume here? So what's actually happening here, again, is more margin calls and rapid hedging that's going to be created here. But the market structure fell apart, and that's where all this volume came out of. It's people forced to long or people forced to cover shorts. Inside of that band, the market's relatively stable. As a matter of fact, when I trade, I like to trade inside those bands most than anything. But when you do break that band, it's also a warning sign to the market. Look, you can't make this up. That exact moment in time, volume came through. Okay? And you can do this every single day. The moment you punch through that upper band, there's going to be volume. Okay? And like here, volume starts to ramp up relative to the average volume around it as you're approaching that band. And even testing that band is a massive volume spike. This is an exploit at the Globex level. So a lot of our stuff is not price action based. We're actually exploiting the CME's own mathematical handiwork and Globex against them. I've read every patent they've put out, so I know how to exploit every single market control thing they have. They control the market like a casino does to keep things nice and stable and steady. But again, I use their own equations against them. This candle, the average right here, is the highest volume of the hour before and after because you touch that band. Puncturing that is a big deal. As you break through it, markets go crazy. Look at this. Look how much the market is going crazy around here. Volume is amplifying like crazy. So there's a margin call and hedging thing that happens there. One of the neat things about these bands, and I'll just tell you as a summary, is that you go back and count. In our classes, we did this. And this was a neat little fun fact because odds are very important. inside of these bands, we found out through the back test. We have to do a recent back test, but the last back test we did 3 months ago looked at like 6 months of data. And of those 6 months of data, 88% of days actually stayed inside of these bands. And only 4% of days would break to the upside and 8% would break to the downside. And another neat thing, and at the edge is a high volume pivot. As a matter of fact, I long from that every single time from the bottom. Outside of these bands on both sides, I do not short the market. So I avoid the market down here by not shorting because only 8% of days stay down there. 88% of days tuck back in. So I don't short outside of the band. As I just showed you that the edge of the band is a high volume pivot in any direction. Now I'm going to tell you how I use these bands to avoid the market. Margin call probability is high. Volatility probability is high. I'm going to stay out of the way. Here's that crash day of the FOMC. If the catalyst didn't get you out of the way, the band certainly got you out of the way. So it's a whole different mechanism. And this got me out of the way as well. This got me out of the way as well. I don't trade much outside of those bands. Most days stay inside of the band. So in the markets, day after day outside of the bands, I also stay out of the way. That's another avoidance trick that made my win rate go up. And so no shorting down here because 88% of days close in the middle. We're adding the two together. 92% of days close above that line. Now up here, one may argue, why not short it back in? And it goes, pardon me. And it goes back to the greater market understanding, is that because 70% of months are bullish and 50 to 60% of days are bullish, and when all of our greater market signals line up, 70% of days are bullish, I just don't short bull markets. And that is what made my win rate go up another 10%, is that I don't try to short bull markets. Because we told you, monthly bull candles, only 20% even sold a third. Bull days don't like to sell. The market loves to be bullish. The stock market loves to move like this and just go up. So even though there's a very high probability that it tucks back in, I still don't short a bull market. So I treat them differently. I will always long back into the band because of the 88%, but I'm never shorting back into the band because why fade a bull market? A blind monkey can throw darts at it and make money. Don't be contrarian to a bull market. That's another rule of thumb. A bull market, another reason is you don't know how bullish it's going to be before it tucks in. So don't even try. It'll take a lot of drawdown trying to time when bull markets end. So I have a rule of thumb. Outside of these bands, I'm long only down here. And because it's irrational and margin call probability is high, let me quiz you guys really quick. I'm longing, but because I know it's a low probability environment and market's volatile, am I trading with a smaller position size? Take a guess. You're right. Absolutely. So I'm longing small outside of these bands because it's a low probability environment. And outside of these bands, because the market's bullish, I'm also only longing small. I will find every excuse to be a bull because if you remember, it takes a lot for me to be a bear. Those greater market indicators, all three need to be bearish for me to be bearish. There's only 3 different places I do short, but there's like 7 or 8 places I do long. And so I'm also longing a bull market small, but knowing that I'm not trying to short back into the middle. So there are only a few type of pivots that I'll chase a long on above these bands, but I'm always in quick and out quick. I'm never betting that the market goes up and stays up because of this. The 88% gets us back to the middle. So I'm willing to ride the wave in small bursts with a small position up here. I'm willing to ride the wave in small bursts with a small position down there to get back in. So outside of these bands, longing is very favorable. The fact that 88% of days stay within the band itself is the perfect pivot to long from or exit a long against on the long side. So I exit my long, exit my long, exit my long right there. If you're shorting, exit your short right there. Don't bet against the 88%. That's another rule of thumb. And these CD bands are fantastic. It's an exploit of margin requirements. And the majority of days are hit the bands. Look, I'm going to show you how cool this is. And this is based on margin requirements. You need to know the most important number to use a futures trader is the margin requirement of the thing you're trading. You didn't know it comes packed with a punch and a bundle of available information that you didn't know goes into that meticulous calculation that the exchange themselves does to make sure the market doesn't fall apart. They're trying not to bankrupt their dealers. They don't want the people dealing cards to you to run out of money. Touching this band is, and falling from this band is guaranteed high volume. Every single piece of this is accurate. I will do 50 examples live on this YouTube and show you high volume the minute you touch it. The minute you touch it to the downside, volume pre-market. The minute you touch it inside, and they're printed at 5:30 the night before, and they last all day in that session. You have this indicator in your back pocket from a day before. Our platform automates this thing for you. And look right here. When you touch the bottom, there's volume. That's also the open of the market, but still, there's volume there. And you can go back as far as you want. It is never without fail to provide a high volume pivot. The minute you touch it, are we convinced so far? This is at 3 o'clock in the morning. Is everyone here convinced that the green line is predictable high volume? Margin calls run rapid on the other side. That's what the volume is. It's structure volume to keep the market in place. Do you guys, y'all want to see like 20 more examples? I can keep going back, but every time you touch the band, it's volume. So volume is present when there's liquidity. It's buying and selling volume, both sides. When there's a lot of buyers and a lot of sellers, just like in the commitment of traders, it's a liquid market. And liquid markets typically find pivots. In liquid markets, I love to trade against. So if I'm shorting the market, I'm going to exit when there's possible volume because a lot of that could be counter volume to my trade. So volume pivots are the most important thing to turn your blind monkey strategy of randomly longing the market to now only longing the market at places that matter, or exiting the market at places that matter, or shorting the market at places that matter. Trade from volume pivot to volume pivot. Of the 15 indicators we have, the overwhelming majority of them are indicators like this that predict volume. So now I can now map out the day to just important levels. Markets falling, markets falling, markets falling, markets falling. Boom, exit my short. At the lowest red candle right there. Look at that. If I went along the market, wait. Boom, that's where I'm going to long. Not here, not here, not here. This is noise. This is structure. Every time we touch, I get this feeling. Okay? All right. So without fail, this band, as you get really close to it, is a volume spike, even more volume than the open. And when you puncture it or tap it again, there's a volume spike. And when you break it, there's volume inside of here. And then now at lunchtime, there's random volume increases because of the margin call. And then volume decreases as the market moves back up because these were margin calls. And then once the people that are frantic are done being frantic, the market makers quickly put price back to stability. It didn't take volume to move this up, which is proof to you, as volume is in decline and you're moving up, that it's not buying that made that happen. It was abnormal selling that made that happen. And the fact that it's curving is telling you that it's people on the bridge yanking other people down. And as soon as all the people have fallen back, the dealers quickly reset the price to stability. So if you didn't know all these things are present, and it takes a mathematician to alert you to all the things I've been training you on, do we see the curvature here? It's curving faster outside of this line. Just like a catalyst, the market becomes insanely volatile outside of these bands. So whichever two of those happen first is a good sit-out indicator as well. And it didn't take volume to rally this back up. It just took people falling off the bridge. And once one person stopped yanking the other person down, everyone else on the bridge was nice and stable. And the market just went right back up to the top. Okay. So yeah, I mean, these bands are miraculous. Look at 10:05 a.m. There's the bounce, right? I mean, you can keep going, keep going, keep going. So what I like to see even further to up those odds of that 69% are days that are inside of these bands as well. And what I like to do is I like to long off of my good, strong, long pivot and exit at the band. This is one of the best things to do. I don't bet against the 88%. The best trading days I have, again, as we're building our strategy, the 3 greater market indicators are bullish. The VIX is below that key sensitivity level, and we are trading inside of these bands, and there's no catalyst. And what I do is I typically long from here to some pivot, or I long from some pivot to there and close out, and I make the majority of my money under those conditions. And if you're trying to find a period of time in any strategy you're using, when does your strategy apply the best that it does? If you have a trading strategy that you don't apply yourself differently at different times, you are absolutely going to lose all of your money trading to me. I will absolutely steamroll your fucking face in the stock market because I am so much more prepared than you are to understand that. You will lose to every good trader on the block who will walk away and pay their Lambo payments with your hard-earned dollars. So make sure that you understand, and this is just to teach you, don't think that this is a sales pitch for our strategy. It's to teach you. If your strategy doesn't have position sizing techniques, market avoidance techniques, you're absolutely missing out on what the pros have and you don't. Forget all the feel-good feelings you have about emotions and this, and like, think strategy right now. We haven't even talked about psychology and emotions. So the idea is you must have trading rules that you apply at certain places and avoid other places. So my best strategy is when all those things line up. I even showed you, I turned a 60-40 bull market into 69-31, almost up that 10%. This ups that even more. Trading inside of these bands are clean, easy trading relative to outside the bands where volatility expands rapidly. So when you start layering stuff together and avoiding the market at certain times, I don't short down here because it pops back in. I don't try to short here because I can take intent amount of drawdown before it tucks back in, right? I have so many good avoidance strategies that when you come to the stream and you hear me sitting out, don't be like, does this guy even trade? The other guy trades. The other guy didn't make any money trading. The other guy burns through hundreds of eval accounts every week and shows you the time they win, but they didn't show you that their $1 million payout probably costs him 800, 900,000 in burnt evals to get there. When you see me sitting out, it's not because I'm a wuss. It's because I know structure. I'm out. I'm not shorting this market here. Look at that. Volatility is insane there. Volatility is stable there. So the idea that time frame does not change the band, Cameron. None of our stuff is based on charting or time frames or candles or anything. It's all based on discrete calculations. The band is based on the margin requirement. And CME changes margin requirements at most once a day. We actually wrote a bot that reads the CME website, grabs the data, and then does the calculation. We reverse engineered their program that sets margin requirements. I did. It's one of my claims to fame. You're welcome. Because I can create high volume pivots with their own margin requirement numbers. How about that? You didn't know you can do that. They use the expected range of risk. This is what they do. They say, there's a lot of risk of high vol. They look for certain moves in the market creating abnormal effects. They know based on everyone's reportable positions that there's going to be volatility here and volatility here. So they set the margin requirement, which fixes the range inside of here. If they make the margin requirement bigger, the range is bigger. They make the contract more expensive, which means fewer in circulation. They use it as a handle. So they take where the risk range is, right? And they calculate the margin requirement. Well, thank you very much. Your buddy Matt here took the margin requirement and figured out how to calculate the range. And there's your range where market makers are getting squeezed down here or providing additional liquidity there. Am I an alien? Yeah, probably. I read a lot. I said technical indicators sound silly. How can price forecast itself? No, you know what? Price is random, but you know what's not random? Volume. I told you almost all of my techniques predict volume. Okay? I'm going to find liquidity. Why is liquidity important? Because liquid markets don't crash. And so while there's your volume, okay, while you guys are out there trying to muscle every single part of the market, I'm over here telling you volatility is stable here and unstable here. Yes, trade here, trade small there, right? And it's like a lot of people, and this is just to prove to you that what the good traders have that you don't is a lot. It doesn't seem like a lot. It might seem like you're just an inch away from what your guru is capable of doing. God, they pushed the button like 5 minutes before me. If I just got in slightly sooner, it's bullshit. They're not making money. The person that's really good at trading has so much more than you do that you didn't even know what they had in front of them. It's insane how many more tools I have than you. It's not even slight. It's not even like, oh, you know what, Matt's just good because he's slightly faster. No, Matt has 50 things he does that you don't do. If you didn't think that complexity is required to be the best or to be profitable, it is. And if people that are teaching you something, well, that's the open, so you can't really say that, are not giving you avoidance strategies and strategies when to bet smaller because you know volatility is going to be higher, or crash detection indicators, they're not showing you their broker statements and how well they actually do. They're not out there winning trading contests. How did I win a trading contest with 500% gain in a month? It's because I'm not being stupid with my money. I'm trading small when volatility is high. I'm trading big when confidence is high. I'm not trading around news and market sensitive. And I know where volume is going to be before I even get close to it. 7:30 before the market even opens, high volume. So I find liquidity. I trade only when it matters. And this is just one of a couple of things. I didn't even show you Rocket Scooter's liquidity maps to go with it. Another high volume pivot are these orange and blue lines you see in futures. This is calculated on futures. When you touch this orange line, there is volume here. When you touch this blue line, there's volume there. These are other volume prediction techniques that we have as well. So we have techniques in futures, techniques in equities, and the idea is because I have areas where I know volume will be, and I have areas where I avoid the market, again, let's put those bands back here. And again, I've showed you very little of what I actually do. 88, 8, 4. Inside of here, I know this is high volume. I know this is high volume. I know this, and this is high volume. And this is the trick that can give you another 10 to 20%, or control at least, if you're good. The idea that all that matters to me are the places where there's volume. I'm not trading here. I'm not buying that dip. I'm not buying that dip. I'm buying here or waiting for confirmation here. And I'm trading to the next high volume pivot and exiting there. I'm trading from volume to volume every single time, which has me more efficient in my long. So now the blind monkey has both pieces of the blindfold removed and is no longer randomly longing the market. The monkey now has new rules that say only long when you can prove there's liquidity. So what you prevent yourself from doing is trading in illiquid markets or trading in illiquid markets when there's a catalyst. So avoid volatility. And now volatility is the lack of buyers and sellers, or lack of liquidity. Now don't let every single market move bait you into moving. No, I'm going to wait for my pivot where there's volume. The long on. I'm waiting. I'm longing. I'm not longing here because it's bumping right up against a potential pivot. I'm too close to that. The reward is much less than the risk. So now what I do in my actual trading strategy that doesn't randomly long the market, it's trade from pivot to pivot where I can prove there's going to be high volume on certain mechanics. And what I do to prove high volume, as you see, those are volume hotspots, is not going to put it past you. We are a group of mathematical geniuses that got together and found out that there are ways to predict volume with mathematics. And we're exploiting certain things in the market that you didn't know were exploitable. This spits in the face of hundreds of years of fundamental and technical analysis. We are the pioneers of volume prediction. This will be what everybody will do in the future. We are just now getting started as of a couple years ago. And the idea is that the casino that you play in has structure points and rules and regulations that keep it intact. The market has a lot of trickery. Markets shut down and mobilize liquidity, and stop trading sometimes. There's a process called velocity logic. You didn't know that even exists. The stock market can change, can gap the price in the middle of the day. You didn't know it could do that either. There is a computer system controlling and regulating the market to prevent the market from destabilizing at all costs. Because when the casino is operating, the power doesn't go out, the house makes a whole lot of money. The CME Group's a publicly traded company. They don't want the market to crash every other day. Liquidity is big business, and they have so many patents and so many rules and so many things that they created that is overwhelmingly. I'm like, am I the first person to pick up this stack of papers and say, wait a minute, this is applied to the market? Everyone has to operate within these boundaries? That's consistency. Indicators are random. Price action's random. But if everyone has to follow this rule, or this thing happens, or this thing is happening universally and everybody's kind of under the same circumstance, then it's repeatable. And I was like, okay, so I can use the margin requirements to extract a range where margin call probability is high, where volume will be. And every single one of our techniques we do uses some kind of principle. The liquidity maps use options to identify where volume hotspots will be in S&P and NASDAQ ETFs. These do the same thing in futures. Each class goes over a specific technique and how I use it and how big I trade on each one of them. Volume prediction is a big part of it, and how much I trade has to do with the greater market indicators and everything else. So now I'm only trading at volume hotspots that I can forecast, and I'm only trading certain times. I'm not shorting up here. I'm not shorting down here. There's only 3 things I short against, and there's certain circumstances I short, and like I say, 7 or 8 things I long against. For the most part, as I said before, the one key element you've been missing from your trading diet is knowing that different environments you need to trade differently. These bands are one of the best tools we have to forecast increasing volatility, right? Imagine waking up at 9:30 in the morning right here, and the market's already down here. Avoid the entire day. Who wants to trade this nasty chop? And not me. You know what I'd rather trade? Nice, clean, easy days like this. And so, like I said, if you're struggling to become a funded trader, realize that there's just a hole in your own strategy. It's because you apply the same rules to every environment. Whereas the difference between you and me is I don't. I have distinct environments that I trade differently in. Certain environments, I'm long only all the time. Certain environments I avoid. Certain environments I trade and trade small, long only. Very rarely do I short. There's only certain environments that I short in. If you don't have different subsets of strategies that you apply in different markets, and a way to identify them, a way to identify when to avoid, and a way to identify your position size, like I said, you will lose over time to traders like me. And there's a million people who are even better than me. But because we do so much, we apply ourselves differently in different environments. And as a trader, that's what you're aiming to learn. Now in our classes, we have specific types of environments and setups, high volume pivots, risk management tools, position management tools that kind of go with this class you guys are in today. You're welcome to take them. Our courses are $20, $1 a day. It's not because we make money off of it. Until you pay something, you'll take it seriously. This is an example of what the classes are like, and we just barely skim the surface of stuff. So the bot's been posting some things, but let me give you guys the link if you're interested in checking it out. I'm the CEO of the Rocket Scooter trading platform. We built this trading platform. Everything we do inside of it is automated. It was designed for risk management purposes. We have a Discord. We have over 10,000 user accounts in the Rocket Scooter platform. We're kind of going mini viral. Our YouTube channel stream has tripled in size in the last 2 weeks. Our YouTube subscribers have doubled in size in the last 3 months. It's incredible how much support we're getting from the community, but it's because people are very interested in learning about a new technique that's not technical analysis. That link I posted is the courses. It's $20 a month. It's nothing. All proceeds go to platform development. I'm the CEO of a company. There's about 20 employees here. They're all building the platform, building new techniques. The majority of our back testing is done by member volunteers, as a matter of fact. We have a whole group of people that are involved in helping us find even better ways to apply ourselves. So the idea is to create tools that all focus on volume prediction and market avoidance and position sizing. The 3 things that allow the blind monkey to win on that trading strategy. Now, again, that was a thought experiment. It's not a real strategy, but I told you over the course of time, we'd build a strategy on top of the framework. The price action is random and technicals won't save your butt. You have to have the other things. Find liquidity and things like that are important. Each indicator is its own separate class, and that's basically it. You guys have any questions for me while we're here? I'm glad you tuned in for this, by the way. We're going to make use of our time off. It's a nice little 2.5 hour session. So remember, if you're in the appetite for learning something new, all we have is new stuff. I'll tell you what I don't do. I don't use technical analysis. I don't use overlaying indicators. I don't use a single indicator that overlays this that uses price action. I don't ever change the time frame from 1 minute. I'm always on the 1 minute chart. These indicators are the same. These levels are the same no matter what the time frame is. I don't use candle patterns. I don't use chart patterns, head and shoulders, bull flags, any of that. None of that. I threw everything out. Time frame doesn't matter. We threw that out. We simplified everything. I only trade at certain areas that matter despite the time frame. I don't look at the candle shape, the chart shape. I don't look at the price shape. I don't look at anything. I don't even look at historic price. That's the one thing that even blows other people's minds. I win trading contests, and I wake up every morning, and I don't even look at what happened yesterday. You will never see me, apart from this class, having the example of, let's look at the weekly daily chart. I never wake up today and look at what's happened. Where's the high and low of the week? I don't do that at all. I wake up today, and I look at today. That's it. And again, it may not be your style. I win trading contests. I don't care what happened yesterday. One final neat little mic drop moment for you is that every day when the futures market opens and every day when the equities market opens, there's a reset button to a new liquidity point. The CME Group calls it the IOP. It's a calculation they use to gap the price to the most liquid spot. That is the rule of that. So when futures markets open at 6 p.m. Eastern, they open at the calculated most liquid spot. So liquidity is when buyers and sellers are in an equilibrium. So the market has reset to the newest liquid spot. Anything that happens pre-market or the day before in futures doesn't matter. And at 9:30, there's a process in the equities world called the MOO, market on open order system, that allows people, large firms, to submit orders to the market maker to get filled at exactly 9:30 at a single price. And they accumulate all those orders from the big firms, and then they gap the price up or down to one specific spot based on where the highest liquid spot is as well. Anytime liquidity is found, the market has reset. So anytime you pass 6 p.m. Eastern or 9:30 Eastern, the market is reset to where everything that happened pre-market or the day before doesn't matter. The market has found new liquidity, and our techniques prove that. My techniques prove that. I don't look at the shape, the patterns, the history, the colored triangles, the vomiting, snake, bear with the hat pattern, butterflies, Fibonacci's, harmonics, blah, Elliott waves, blah, blah. Nothing. None of that. I threw everything out. And so our stuff is seated on other complex principles, liquidity, like finding liquidity, gamma exposure models, things like that. But we don't overwhelm you with the math. We just tell you there's a high volume pivot here. You may not know that this orange line is the maximum gamma exposure of monthly held options by market makers of the underlying futures and equities options. And that may sound like a mouthful, but basically this means high amount of delta hedging is going to produce a high amount of volume. And you can't argue with touching this orange line being volume. So whatever the mechanism is, you can just take it for a grain of salt. But observably, when you touch these orange lines, or this pink line, there's volume. Here there's volume. So the idea is we use different, very, very complex pieces of the market just to find volume for you guys. And you have to learn the math. You just learn that orange is a pivot that goes this way. But we do go into detail about the why if you're interested about it. So just remember, there's a lot more. The whole point of this class is to prove to you there's a lot more to trading than you ever thought. It may be overwhelming to you to know what the good traders have that you didn't have. And it may tell you that now you have a lot more time ahead of you in your journey to becoming profitable. I promise you, the guru you watch, or the guru that sells you a tool, you're not going to pick up the best tool in the world and immediately do well, especially if their tool doesn't have avoidance rules and position sizing rules. Those two things are required for you to make money as a trader. They're required to allow you to survive, to be a roach, to crawl out of the fallout. So if you don't have those, you need to question the person that's teaching you. And that's it. That's all I've got for today. So appreciate you guys being here. Like I said, if you're interested in learning our volume predicting techniques, you can use mechanical things to predict volume without fail. And it's really good at doing that because the systems are repeatable. And because they're repeatable, you get my volume. You can't predict if that's buying and selling volume, but you can just predict its volume. So you have a better chance longing from here or shorting from here than longing or shorting from anywhere else. If you find where the volume is, it's just like that house metaphor. You can prove that there's a higher chance that someone's going to come in and buy after you. If you're the first one in on the long right here, and then a minute later, the volume rolls in after you. That's kind of the trick I use. So thanks for tuning in. We're just scratching the surface. So I hope you guys check out the courses and you can learn a whole lot more. All right, we'll see y'all later. Go to discord.gg/rocket scooter to learn more about what we do. We're a team of engineers that built a trading platform and been a whole kind of analysis that immediately has thrown out fundamental analysis, charting, technical analysis, chart patterns, candle patterns, and time frame confluence. All that stuff is a failure because it applies itself the same way in all markets. As I hopefully proved to you, that's a failed application. There are things you didn't know that exist. Volatility, how to detect it, how to avoid. Catalysts, how to avoid. Where markets are liquid and not liquid. Why is liquidity important? How to find it. These are things that a master trader has in his tool belt. If you're looking to become a master trader, you're going to do this for a living, search for things like that. Even if it's not through us, look for them out there. These are the things that you need to hit your goals as a trader.